The market's going through a transition right now.
We've had so many people chasing these rate cuts, chasing these higher valuations, that I think we're due for that correction.
It's impossible to believe they're going to hold rates at these levels forever. But the timing question is a big one.
Higher long-term rates are something we can learn to live with.
You can live with slightly higher inflation and a slightly higher Fed funds rate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
In some ways, earnings season begins right now. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 snapping that six-day losing streak in yesterday's session. On the S&P this morning, positive by 0.1%. One stock that did not snap the streak was Tesla. 7 days of losses going into earnings a little bit later on this afternoon. On the month, down by close to 20%. Bramo, year to date, down by more than 40.
It has been kicked out of the Magnificent Seven, but more importantly, the idea of profitability in China has been wiped off the table with the latest price cuts. We have a company that is fighting a sentiment wave as well as the very real wave of competition in China during a fraught moment for the electric vehicle market.
The list of issues is so long: pricing, leadership, product release, competition in China. We're trying to figure this out. I think we've asked this question a few times on this program over the last few weeks. Annmarie, what is a Tesla problem and what is just a broader industry problem right now?
Well, it's a great question because you're seeing this EV demand really wane around the world, especially in key markets like China. The issue is you do see China national companies like BYD doing very well. The issue seems to be in other places, especially in the likes of the United States. When it comes to Tesla, though, Jonathan, the problems just continue. And overnight, we even had an exclusive story about the newly formed marketing team is part of those company-wide layoffs. And this was supposed to be to get the message out in advertising. Because once you saw the Inflation Reduction Act come out and those tax subsidies, a lot of people went out and bought EVs. But now that demand is really starting to wane.
We've heard about problems in China for a while, not just for Tesla, but for Apple as well. Waking up to another story on Apple. More bad news for the stock. This time it's Counterpoint Research, Bramo. iPhone sales in China falling 19% during the March quarter. The worst performance there potentially since COVID back in 2020.
And it's losing market share. And I think this is the more important point, the idea that the Xiaomis and Huaweis of the world are taking over, which raises this question: how do they get a foothold in a country that is going to push its own brands? This is the reason why Apple, Tesla, they're kind of in a world of their own. They're dealing with the China question in terms of demand, but they're also dealing with this broader demand question for their products, which is the reason why increasingly we're seeing this fissure in big tech earnings between the Microsofts, the Googles, even the Metas, versus, say, the consumer-facing ones, as Mandeep was talking about yesterday.
The more interesting number was Huawei, in contrast, climbed almost 70%. You see Huawei and these national champions in China doing very well at the expense of the likes of Apple. And this report comes after Gina Raimondo went on 60 Minutes and said, actually, we're out-chipping you. We're better than you. Our product is better. And you have to think, is it? Because Huawei in China is taking Apple's market share.
Lisa nailed it. This is not a market problem. This is a Apple problem. And you see that in the numbers. This is a growing market and they're losing market share. You see it against the likes of Xiaomi, Huawei, all rising to the top. My favourite story this morning, though, none of these. It's not Tesla, it's not Apple, it's this one right here. The US Federal Trade Commission suing to stop Tapestry and its $8.5 billion takeover of rival Capri Holdings. So this is Coach going after Versace, looking for a piece of Jimmy Choo. And the government's worried about more expensive handbags. Are we for real? Is this a story?
They're suing this, and the FTC voted unanimously on this. What I take question of, and Capri put this out in the statement, is why was this able to get through the regulators in Europe, which is a highly regulated place, and Japan, yet it cannot get through the US FTC? And this remains a question of, can any deal get through with this antitrust enforcement individuals at the top?
Come on. You need your Jimmy Choos, less expensive. Like, we've seen real inflation in luxury. You know, it's time to target it, the price gouging in the luxury sector.
I thought we're building the economy from the middle out and not the top down.
Well, this is helping all.
What is this?
This is evidently, you know, honestly, Michael Kors handbag, your shoes, you know, they're going to be a little bit cheaper now, maybe. Who knows?
I think it's affordable luxury, right? So maybe that's the
entry level.
Entry
okay,
level.
We care about entry level. This is ridiculous. More on that story a little bit later. Plenty of earnings this morning. Let's kick things off with UPS. Those numbers just dropped moments ago. Adjusted EPS, Lisa, coming in at 143. The estimate was 130. I understand they've reaffirmed their guidance this morning as well.
Yeah, talking about average daily volume in the United States showing improvement and expecting a return to volume and revenue growth. When you look under the hood, there's a lot of cost cutting, not necessarily as much of in terms of growth of just the overall. But this doesn't necessarily speak to some sort of massive slowdown in the consumer spending or even in the goods sectors, considering that they're going to bring back to some sort of normal level in the near future.
Stock is up in the pre-market by 1.4%. The broader market, if you're just joining us, welcome. Equity futures on the S&P 500 shaping up as follows. Futures pushing higher by 0.1%. Yields just a touch higher by not even a basis point on the 10-year, 461.69. PMIs in Europe coming in just a little bit better. Doesn't really buy you much euro strength, up by not even 0.1% now. That move faded ever since that data came through. 106.61 on euro dollar. Coming up this hour, Steve Chevron of Federated ahead of Mag 7 earnings. Bloomberg's Ender Curran as iPhone demand plunges in China. And Andrew Honhorst of Citi explaining how the Fed may still deliver 5 cuts in 2024. We begin with our top story. The S&P 500 bouncing back above 5K as Mag 7 earnings kick off a little bit later this afternoon with Tesla. Steve Chevron of Federated saying this: while we recognise markets may be choppy in the near term, we view pullbacks as attractive opportunities to add to equities as the market marches towards our longer term 6,000 target. Steve's with us in New York. Steve, good morning to you.
Good morning.
Last time we spoke, you said back in March that it was hard to sell this market. Is that still true?
Yeah, I think that's right. I mean, you had the ingredients for a pullback. I think we're probably in the middle, not at the end of one. But it's probably not tradable. I mean, I think you've got a lot of folks that are itching to get in the market. And when I hate to say this because it's an old term, but cash yields have probably peaked, right? We think that you're still going to see some rate cuts in the offing. Again, it's probably 1 or 2, which has been about where we are. There's a risk of 0, which is not a 0 risk. So you got to be mindful of that. And with the market repricing higher, bonds aren't all that attractive here in a rising rate environment. So you look out. You saw the UPS numbers. The economy's still relatively strong. The consumer's hanging in there. Earnings are doing okay. How do you not want to own equities?
You're making quite a powerful point with a 2-year close to 5% and a 10-year through 460. Are you saying that doesn't provide much competition, or that competition is in the process of peaking?
Yeah. I think when you look at where cash yields are going to be, when you get rate cuts, those yields are going to come down. As you look at where the 10-year is, you know, from our perspective, it's hard to envision a world, even if you got 2 cuts, but you had a little bit of steepening of the yield curve. This 10-year looks fairly valued to us, somewhere between 4, 4.25, maybe even as high as 4.5. So it doesn't I mean, there's some value at 460, but it's not like a pound the table screaming value there.
One thing, it's just amazing to me that everyone was talking about it broadening out, and that was the way to go. That was where the value was. Now we see sticky inflation, the idea of rate cuts being priced out of the market, and it strikes me that in that environment, you stick with the big behemoths that have cash, that are going to do just fine, and the smaller companies are going to keep struggling.
So we're not there yet. You know, we came into this year with a kind of 1 to 2 cut forecast, despite, you know, futures pricing in 5,
so you were
6.
Right.
Well, no, but the question is, are we going to be 2 right? So, you know, 1 to 2 is fine, right? In a 1 to 2 cut environment, if that's, you know, leading into cuts in 25, I think then you still get that broadening out. And the underperformance of those parts of the market through the first 4 months of this year will have been a nice buying opportunity if you weren't in it. If that ends up being 0 cuts, and now you're questioning 25 cuts, then I think all bets are off. So from our perspective, because we still do see kind of 1 to 2 cuts, at least at this point, we still think that broadening out trade will ultimately be right. But if it's 0, then probably that's pushed back.
Can you give us a sense of what you've been doing over the past couple of weeks? Is this basically seeing Mag 7 fall out of bed? You're aggressively buying, you're getting ready for that to still be the leadership, or are you basically just sort of watching this all and saying, I'm not going to do anything. It's just noise. We're still marching towards 6,000.
So at the risk of sounding right again.
How could you?
We've been I'm not going to lie.
That is quite a line, Steve. That is beautiful.
Carry on.
Well, there's a live TV moment for you. We've been underweight the Mag 7. We've been underweight growth. We came in this year with this idea of a broadening out. We took a little bit of pain in the first part of this year on that. But the idea was, one, when you look at the relative earnings growth, it's going to decelerate for that Mag 7. And it's going to be overtaken by the forgotten 493 as you get deeper into this year. And given valuations, given names that ran hard in earnings, and given this idea that if we do get rate cuts at some point and the economy is stickier, that there's some catch-up play. And so we haven't done anything in the last couple of weeks. We've debated, we've talked, but the market's kind of come to our positioning.
What do you make of some of the noise that some are saying, and even the options market is starting to price in, I think, a 20% probability that there actually could be a hike?
We're not there yet. I mean, look, I think this Fed would be loath to hike. I mean, they've gone through so much of the political capital work here in preparing the market for cuts that now I think they're frustratingly being delayed and putting through. To do an about face, I think you'd really need to see inflation not just be sticky, but reaccelerate. And that's the big question for us right now, and I think for the market. Is what we've seen inflation that's sticky within a range, or is it truly reaccelerating? And we're asking that question, but we're not yet ready to say, okay, this is reaccelerating and we're back in a hike scenario and all bets are off. We're not there yet.
Just to be clear, if it's sticky, that's still a buy on this equity market. That's good for stocks.
Yeah, sticky's okay because, look, sticky means that you're in a range, you're probably grinding lower, rate cuts can come, you can get that broadening out, and that's better than plummeting inflation in the face of a growth scare. But reaccelerating inflation, which brings hikes back on the table, that's a very different scenario, and I think that challenges multiples.
Is there anything in the growth inflation mix right now that you think risks squeezing margins for corporate earnings going forward from here?
Yeah, we were talking about this just yesterday. I mean, you've got, if you think about where you are versus the beginning of the year, you've got energy prices that are probably higher than you would have expected. You've got overall inflation, particularly goods inflation, which has at least stabilized and kind of ticked higher. And then the question in the earnings estimates are how many rate cuts are priced into those bottom-up estimates. And if they're not going to come through, there's an interest expense there. So we've been bullish on earnings, but that's something that we're sharpening the pencil on and trying to understand, could there be a little bit of a downside surprise?
John, to that very point, average daily package volume for UPS came in above estimates, but revenue per package came in below estimates. So kind of very much speaking to exactly this point. I would hate for you to have to leave without commenting on expensive handbags and what you feel about the consolidation in the fashion industry and whether you think that this is going to harm the American consumer. How do you sort of factor this into your investment thesis?
Well, given the mood around this table before going on the air, I wouldn't dream. I wouldn't dream of supporting.
You can't discuss that.
The FTC here because I might incur violence. No, I mean, look, I'd say it this way. I mean, I do think that there have been a number of merger and acquisition opportunities that have been blocked at the FTC for companies that I think from our perspective are folks that are trying to stay alive and trying to improve a competitive position that are not really in danger of creating any kind of monopoly position. I would agree that this is one as well. Now, it's not necessarily a pocketbook issue, but it's a handbag issue for many American consumers.
Nice, Steve. Did you do that on the spot?
I did.
That was good.
And so I think it's terrible, and handbags should be much cheaper.
I think we're on the same page, Steve. Totally agree. Well said. Steve Chevron, Federated. Steve, thank you. That was perfect. More news for you. Earnings, PepsiCo, beat on the top and bottom line. Core EPS coming in at 161, the estimate at 152. Pretty solid international growth as well. Not a big move in the stock. The stock at the moment, a little bit negative, softer in the pre-market on PepsiCo at the moment, down by about 0.5%. More earnings throughout this morning. Let's get you some news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. UBS is pulling back on plans to build its own mutual fund in China. Sources say the Swiss bank will instead rely on existing joint ventures. It cited high costs and a dim profit outlook. UBS had been contemplating a standalone fund platform since 2020 when China lifted foreign ownership restrictions. Tesla is being sued by a former employee who claims the company's decision to lay off 10% of its workforce in a global retrenchment broke the law. According to the complaint filed in a California state court, by not giving 60 days notice per state law, Tesla, quote, acted intentionally and with deliberate indifference and conscious disregard to the rights of its employees. Apple is close to inking a deal with FIFA to get rights for a new month-long World Cup-style competition. That, according to the New York Times. The tournament is scheduled to be held in the U.S. next summer. It would be Apple's latest venture into soccer, following a 2022 deal when it secured a 10-year contract for the worldwide streaming rights to Major League Soccer. That's your brief, John.
Danny, appreciate it. Thank you very much. Up next on the program, U.S. tech struggles in China.
The China shock continues. What you've seen is something we've seen over and over again, creation of excess capacity, overproduction that brings down prices.
It has been pretty shocking for the likes of Apple. That conversation up next. Bouncing back from 6 days of losses on the S&P 500 in yesterday's session, attempted to add some weight to that. Equity futures up by 0.2%. The bond market pretty stable, 461.48. It is all about the earnings this week. Under surveillance this morning, US tech struggles in China.
The China shock continues. The Chinese double down on their what we call non-market practices, their state investment in a strategic emerging sector. And what you've seen is something we've seen over and over again, creation of excess capacity, overproduction that brings down prices. It's a kind of predatory pricing practice.
It's the latest this morning. Apple iPhone sales falling in China by 19% during the March quarter, according to Counterpoint Research. That marks the iPhone's worst performance in the region since 2020. This as the company faces increased competition from rivals like Huawei and Xiaomi. Bloomberg's Ender Curran joins us now to discuss. Ender, let's talk about some of the complaints. Excess capacity, overproduction, heavily subsidized product, and then just fierce competition. And this story with Apple feels a lot more like fierce competition than anything this government is complaining about. Can you walk us through the forces that are holding back some US tech firms?
Well, I think there's one stat that speaks to your point, Jonathan. Huawei sales in the quarter rose 70%, even as Apple shrank. And that speaks to the idea that China is innovating and driving its homegrown technology now that can compete with the best of the best. Now, at the same time, we did, of course, have some other detail within that reading on Apple's earnings in China over the quarter, which is that it came against the backdrop of the Chinese New Year, which is meant to be the time of year when consumers are buying and spending. When it's clear they were buying and spending, they just weren't buying US phones, they were buying Chinese-made phones. So I think it does lend itself to the idea that there is a homegrown base. Now, we're seeing that among electric vehicles as well. Tesla there discounting its vehicles in an attempt to generate sales at the same time because they're facing fierce competition from homegrown Chinese technology. And also, it should be said, ahead of Blinken's visit to China, there was a very rare briefing from the Chinese government to our colleagues in Beijing where they pushed back heavily against these US criticisms of overcapacity and the like. They accused the US of naked economic coercion and bullying. So I think two things coming out of these tech earnings at the moment, John. One, speaking to rising Chinese competition, no doubt about it. And then secondly, China's pushing back hard on this idea that they're exporting spare capacity to the rest of the world.
Let's just sit on the former before we get into the latter. I want to talk about that increased competition. You alluded to it, and nationalism. The consumer choosing Chinese brands over American products. It's not a new shift, and do you just sense it's gathering pace, looking at what's happening with Apple, with Tesla?
Look, there's clearly explicitly part of the story is nationalism because the government, for example, has put restrictions on which kind of companies can buy Apple iPhones in the first place, Apple devices. You know, state-owned companies, government agencies are not allowed to hold Apple phones. That is naked nationalism, there's no doubt about it. Now, it's obviously harder to discern that among the consumers, but as I said to you, the data for that quarter speaks to the point when you see Apple losing market share, but at the same time, Huawei gaining ground there by 70-odd%. That speaks to the idea that money is there, consumers are still spending and willing to buy these devices, but Apple's losing out. Now, of course, the tech experts will say to you the real test will come in the fall when Apple's launching its new devices. It will be interesting to see then if it can rebound, and that will tell you how much of this is nationalism or not. But there's no doubt at the moment there are tensions, and that is being reflected in demand for Chinese versus US goods.
Commerce Secretary Gina Raimondo on 60 Minutes on Sunday evening, quote, "We have the most sophisticated semiconductors in the world. China doesn't. We've out-innovated China." Well, the data clearly shows they haven't, Enda. Is that correct? China is almost on par with the U.S. when it comes to at least the chips that are needed in smartphones?
Well, look, there are tech experts who will make the same point that China isn't quite along the spectrum of technological innovation that the US is yet. But equally, though, there are critics of US policy who will say that all that the US is doing is accelerating China's own homegrown technological innovation, forcing it to double down on R&D. And we're seeing that in the pronouncements from the central government in Beijing over the last few months as they set out their economic policy for this year and the years ahead, making it clear that technological innovation and high-end manufacturing is a top priority for the government, probably ahead of lots of other traditional areas that drive economic growth. And that's what critics say is one of the spin-offs from the current US policy. You're just doubling down, forcing China to double down on where it's at, and eventually they will make some breakthroughs. And as we're seeing, Huawei gaining ground there in that first quarter, partly in the back of that revived model that they launched last year.
And you mentioned Secretary Blinken's travels. He's going to be leaving today to go to Beijing. When you look at this relationship, the Chinese government is certainly going to complain about potentially the EV tariffs, more of them that are coming down the line, the probe into the shipbuilding sector, the TikTok divestment or ban that potentially is going to get a vote today in the Senate. Which is top of mind for Beijing?
There's no doubt about it. On paper, this, Annmarie, the relationship is stable right now. It's probably been the best it has been in a couple of years. Officials are going to both capitals for talks. Yet, as you say, these measures continue, especially on the US side, continue to try and double down on punishing China where they can. But we're now starting to see a hint of pushback from Beijing. As I say, there was that rare briefing from Chinese diplomats ahead of Blinken's visit, and they're pushing back hard against these charges of overcapacity, in particular, for example, making the point that, as I mentioned earlier, they're accusing the US of naked economic coercion and bullying. These are pretty harsh and striking words that the Chinese are using, and I think it's the harshest rebuttal so far to the overcapacity story. So that one does seem to be striking a chord perhaps above all else, and I think it'll be very interesting to see how these talks with Blinken goes, both in terms of overcapacity, and we've reported that Blinken plans to make clear in terms his views in terms of China's company supports for Russia too. So there's two prongs where we could see tensions flare anew on the back of this trip.
One thing that I find striking is a lot of U.S. officials have met with a lot of Chinese officials. There have been a lot of talks. Do the diplomats and other officials in China speak with Xi Jinping after speaking with U.S. officials?
Look, I think there's no doubt there's hardly a unified approach when it comes to dealing with China on this, on several issues, be it on economics or be it on national security. We saw last week with the German Chancellor's visit to China, plenty of analysts saying mixed signals coming out of that, not necessarily on the same playing field or the same hymn sheet as the US. And that's a continued process. We see the US taking steps that in some cases are unilateral, sometimes with EU or broader backing, and sometimes without. So I think if you're talking about a unified approach to China on economics or on national security, I don't think it's there yet, Lisa.
And great to catch up, sir. And Karen there of Bloomberg on two big issues there, what's happening with US tech into China and also the tension in the South China Sea. I think we all saw that quote overnight, Bramo, increasingly concerning.
Especially at a time where it seems like, and this is the reason why I was asking about this, Xi Jinping has aims that are somewhat divorced from economic growth or what's happening currently with the economy, which is the reason why there's so many mixed signals for private companies, international companies that want to go into China. Do they want them or not? Because right now, it's not clear where the priority is.
This line from the outgoing head of the US Indo-Pacific Command, we all need to understand that it's moving very fast. The build-up of military power despite a bad economy, the increased narrative of all things inside the 10-dash line, a Chinese sovereign territory, then the actions that are going towards enforcement. There's a lot there. A lot to unpack. It's a long list of concerns.
And it's also why potentially you see the United States today and the Philippines conducting military exercises near the disputed South China Sea and Taiwan. This is certainly going to get the backs up of the Chinese delegation, though, as Blinken arrives in Beijing.
That's the latest on China. Coming up very shortly on this programme, Dominic Assam of SAP on company earnings and the growth in AI from New York City this morning. Good morning. Equity futures doing okay, positive by 0.2%. A bit of a lift yesterday, bouncing back from the longest losing streak we've seen in quite a while. Certainly the longest losing streak so far this year. 6 days of it on the S&P. A small bounce yesterday relative to the losses we've built up over the last week or so. On the Nasdaq, positive by 0.3%. The Russell just about positive as well, up by 0.1. Lots to talk about in the earnings front. We'll do that in a moment. Kicking things off is Tesla a little bit later on this afternoon. If you switch up the board and get to the bond market for the third time in about 2 weeks, breaching 5% on a 2-year yield briefly. We're back down to 498.26, up a single basis point. And a conversation earlier on this morning already about how much competition, Lisa, that provides to the equity market and whether maybe we're seeing the peak of that competition. Certainly the view of Steve Cheverone of Federated.
If you think that yields are going to go lower from here, maybe slowly, but albeit lower, then the opportunity in cash becomes less. And then suddenly that wall of cash needs to go somewhere. A lot of people talking about yesterday, the bid into stocks was supported by the fact, to your point exactly, that crossover 5% was brief. It didn't stick. And there was a feeling that at least there was some sort of floor under Treasury valuations for the time being.
Unlike back in October, we haven't seen that sustainable break of that so-called line in the sand. Let's take the bond market action, fold it over to what's happening in foreign exchange. The euro just still stuck around 106. It's interesting to see this play out. 106.59, positive by not even 0.1%. Data was decent. I mean, relative to expectations and where it was before. Upside surprise on the PMI. I think the Eurozone composite now 11-month high, Lisa?
Yeah, although it's driven by the services, because what you saw was manufacturing came in below expectations. And really, it's kind of a question of, OK, how long can services growth continue to fuel an economic trajectory without inflation that could be punitive and lead the ECB to keep rates higher for longer? It's a mush right now. And frankly, when you look at the euro, it's in the same place. It moves just incrementally. Elsa Linos thinks that there's actually signal there. She was saying that yesterday, maybe that means that actually pretty much all the dollar strength has been baked in. I get the sense people just don't know what else to do right now. Because what direction are we getting right now?
Pause to reflect or pause to get confused. Isn't that what Kit Jukes of SocGen said? The more I pause and look at the euro, the more confused I become. The euro 106.58 at the moment. Under surveillance this morning, Mag 7 earnings kicking off today with Tesla after the closing bell. Investors will be looking for details on Elon Musk's robo-taxi announcement, as well as plans for a new, cheaper vehicle. Results from Meta, Alphabet, Microsoft round out the week. Next week, we'll hear from Amazon and Apple. Right now, we're hearing from GM, raising their full-year guidance. They now see adjusted EPS at $9 to $10. That's the new range. The old range was $8.50 to $9.50. The stock is up, Bramo, 3.4% in the pre-market.
Yeah, what's interesting to me is they sort of kitchen sinked it, right? They were talking about how they were going to be cutting back some of their expectations for electric vehicle production, et cetera. Now they're raising full year guidance. This is a view they can see. I think the fact that they even have guidance is really telling. They have moved out of no man's land if we don't know what this is going to look like to, yes, this is going to be good. Why? Because truck sales are continuing. The China slump doesn't affect them as much because of that. This isn't driven by electric vehicles. This is driven by their bread and butter, and their bread and butter is doing just fine.
These are the cars Americans want. The EV almost feels like we hit the peak when after the, tax subsidies came out, there was some move towards it, but there still is a ton of work to do in that space. And until they can get an EV truck or hybrid truck that people like, this is the demand, what the people want. And the fact that even though they're continuing to struggle in China, but they're still able to beat because of that demand when it comes to things like truck, I think just shows where the market is right now.
This could be the potential distinction a little bit later as well. If you can overcome the slump like GM just has in China, that's the question I think for Tesla a little bit later, which has clearly struggled. Can they do the same thing?
Well, frankly, GM didn't hinge its sort of truck, to put some random phrase out that absolutely made no sense, to China, right? Basically, we're talking about a company that really kind of relied on the U.S. Buyer base. And so they are winning as a result of that. Tesla is not that case. Neither is Apple, which is the reason why we keep linking the two.
GM is up by more than 4% in the pre-market. Elsewhere, the latest here, Columbia University announcing classes will be held remotely as anti-Israel protests continue on campus. Yale and MIT experiencing similar demonstrations. President Biden telling reporters, quote, the following. Here's the quote, Bramo. You tell me what you think about this. I condemn the anti-Semitic protests, and those who don't understand what's going on with the Palestinians, I condemn them too.
I can't explain it exactly because I interpret it in lots of ways that probably are my interpretation. Look, this is a very difficult moment for him in terms of how to message it, because you've got one wing of the Progressive Party that are very much in the camp of some of these protesters. And then you have a lot of people who think that, you know, if people's personal safety is being threatened in any capacity, that's a line that should not be crossed. The bottom line to me, and I'm sorry, but I see the protests, and part of me is like, you know what, free speech, I totally adhere to that, but each university should have its policies, and if someone violates those policies, it is private property, they can enforce those policies. And if it's civil disobedience, you have to basically adhere to those policies. The idea of making a free space and a sort of feeling of safety, I think, is fine from a physical level. Emotionally, universities should challenge people.
These Biden statements come after we heard from the White House over the weekend, a lengthy Passover statement from the president himself, and then Deputy Press Secretary Andrew Bates had this to say, talking about blatant anti-Semitism. The issue with these protests, beyond free speech, the anti-Semitism, he says, unconscionable and dangerous. And the reason why this is going to get very political is you have senators coming out on the Republican side telling Biden he needs to bring in the National Guard when it comes to some of these universities. When you look at what's going on in Columbia, and then very late last night, a lot of individuals were arrested outside NYU by the NYPD for protesting. This is going to become an issue because these protesters are the youth. And that's kind of the issue here. They are going to lean mostly to the Democratic Party, but Biden is trying to toe that line, really, in terms of making sure he's on the side of Israel and anti-Semitism, but making sure also he speaks to the youth vote.
We'll talk about that story a little bit later. Let's move on to this. The FTC is suing to stop Tapestry's $8.5 billion takeover of rival Capri. This marks the first move of its kind by the Biden administration in the fashion industry. Regulators alleging the deal would harm consumers and workers. The Tapestry CEO saying in an interview that shoppers have a wide range of brands and price points to choose from. It's unbelievable we're having this conversation. Let's just go back to the question we've asked repeatedly, regardless of the industry we're talking about. Has this government just decided that any consolidation is just bad? Bottom line.
This is the question that a lot of executives are asking. And we've heard from Brian Moynihan, we've heard from others that basically a lot of companies are not really going to begin engaging with M&A until they have a better sense of what the framework is. This just adds to those questions.
Talking to some of the forces we've discussed over the last 30 minutes or so, some of the challenges, you'd think this would be somewhere near the bottom of the list, the price of handbags, but that's where we are. Elsewhere, software company SAP gaining this morning after reporting earnings boosted by artificial intelligence. Europe's biggest software firm posting record growth as it looks to move customers from its legacy business to the cloud. Dominik Asam, the SAP CFO, joins us now for more. Dominik, I'm sure you're in a good mood, so thank you very much for being patient and waiting for us to get to you. Let's talk about these numbers. This growth is coming at a time where there are some concerns on this side of the Atlantic about cloud growth for some big tech players. Where is your growth coming from? What are the tailwinds through 2024?
Yeah, of course, the advent of AI has clearly propelled the story of the transformation to the cloud to move our customers from their on-prem installations onto cloud, resulting in an uptick on a constant currency basis by 25% in our cloud revenues. Our more forward-looking so-called CCB, which is basically the 12-month ahead subscription revenues we've already contractually locked in, is even growing at 28%. That's a record growth. And all that is driven really by the core offering we have in the cloud, which is called the Cloud ERP Suite. That offering has actually generated in excess of 30% growth for 9 quarters in a row now.
What is the demand, Dominik, in terms of the specific applications of artificial intelligence in the cloud that you see most commonly invested in by the companies who are your clients?
Well, it's a broad set of applications throughout the enterprise, on HR, on finance, on the supply chain. So there's actually no exclusion, I would say. It's really, really broad. We have brought about 30 use cases recently to the market. We are planning another 100 to come. We already have more than 27,000 customers using AI-powered use cases in the corporation. The 300 million users we have by now in the cloud are really benefiting to make themselves more productive and to fight, for instance, rising inflation and salaries.
How much are you winning market share versus simply just capitalizing on the incredible demand that we see right now for artificial intelligence?
Well, undoubtedly on the Cloud ERP Suite, we do win market share. I mentioned the 30% plus growth we have. The market is more in the low to mid-teens. So that's a very tremendous outperformance. It's like more than twice the performance of the market.
So from who? Who are you gaining market share from in particular?
Well, Sometimes it's kind of homemade solutions we are displacing. Sometimes it's also against our key competitors. It's also the fact that SAP has been more focused on the on-prem installations, i.e. software deployed by the customers. Now we're really moving to the cloud. So we can convert that huge customer base on-prem into the cloud, and that drives the growth I mentioned.
German Chancellor Olaf Scholz was recently in China, and the head of your Greater China region for SAP was talking about how this was a good thing and potentially there could be more of an expansion of SAP in China. Are you concerned when you see news coming out like Apple overnight about how they have this diminished share when it comes to Chinese revenue?
Well, actually, if you compare us to other global tech players, we have actually a relatively moderate share of revenues in China. We do see growth opportunities, but honestly, there are other markets which move the needle much more for us. So we're not really concerned on that front.
What other markets are moving the needle?
Actually, we have been super strong in Asia-Pacific outside China. Also, Europe, good old Europe is doing quite strongly. And last but not least, the biggest market for us is the United States. And we've also great traction here in the United States.
Dominic, at the start of the year, you announced a restructuring back in January. It was set to affect something like 8,000 jobs. I think initially it would give the impression that maybe you were consolidating and pulling back. And that's not what I hear from you right now. Are you hiring in certain places, and where are you?
Yeah, we are actually hiring as we speak. I mean, the restructuring program is now on its way. You mentioned the 8,000 people we are going to reduce. And this is really to focus all our resources on those strong growth markets that really matter, to invest $1 billion into AI in 24-25, to accelerate, to spin the flywheel. On the other side, there are areas which don't grow, which are actually in decline. So we have to make that adjustment and really are in the middle of that. So execution now is key to deliver the financial performance we have kind of indicated.
Well, it was certainly a good quarter based on the numbers, Dominic, and you're having a good day so far. The stock is higher. Dominic Azam there of SAP. Dominic, thank you, sir, for joining us. The stock is higher by something like 44% over the last year or something. So decent run.
It's the part of the granola that's working, because some of the other parts of the granola, the big shares in Europe that have been really outperforming, faltered a little bit, but they seem to be continuing to outperform.
That's the latest from SAP. If you are just joining us, equity futures right now on the S&P 500 positive by 1/3%. That's European tech. We'll talk a whole lot more about US tech through the week. We're going to hear from Tesla a little bit later after the closing bell. Then on to tomorrow, we'll hear from Meta. Then it's Microsoft and Alphabet to round things out on Thursday. Looking ahead to next week, Amazon and Apple. You work your way through May, we're going to hear from the likes of Nvidia. So it's the first one out the gate of the Mag 7 a little bit later after the close. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Let's catch up with Danny Berger. Hey, Danny.
Hey, John. We're going to stick with Europe, where Euro area PMI suggests that a recovery is gaining momentum. The readings hit the highest level in almost a year, with strong services and Germany's return to growth. Now, it's the kind of data that will likely strengthen the case for the ECB hawks, that potentially, after a well-broadcast June cut, that there should be a pause. The U.S. is reportedly drafting sanctions that would cut off Chinese banks from the global financial system, that according to the Wall Street Journal. The effort is to stop Beijing's commercial support of Russia's military. Secretary of State Antony Blinken is headed to Beijing today. Shares of Spotify higher in the pre-market, 8.25% after their earnings. They reported paid subscribers that rose 14% year over year. Now it sits at almost 240 million. Spotify had raised prices and plans to do it again for the second time in just a year. That's your brief, John.
Danny, thank you. Up next on the program, the Fed can still deliver.
The Fed is really determined. And that, to me, is the difference between really staying on hold or deciding that they want to take this plunge into the rate cut pool.
Citi's Andrew Hollenhorst thinks they will. He's making the case for 5 cuts in 2024. That conversation is up next. Stocks near session highs, positive by 0.3% on the S&P 500. Equities just pushing a little bit higher. Yields going absolutely nowhere on the 10-year, 461.27. Under surveillance this morning, the Fed can still deliver.
The Fed is really determined. And that, to me, is the difference between really staying on hold or deciding that they want to take this plunge into the rate cut pool. It would take a really big revision higher in their sort of R-star estimates to get us to a place where they really feel comfortable staying on hold. I get caught in this sort of question of, do I think they should cut or will they cut? And again, it just seems like really the best argument today is that they want to.
They want to. Will the data cooperate? That's a question we've heard asked a million times on this programme. Here's the latest. Investors looking ahead to Friday's core PCE data for clues on when the central bank might start cutting interest rates. Citi's Andrew Honhorst saying this: we continue to see the most likely first cut in June and project core PCE inflation to fall to 2.7% year over year next week. Our base case is for 125 basis points of total cuts delivered this year. Andrew is with us around a table. Andrew, sticking with June, looking for something like 5 cuts in 2024. I imagine you've had some pushback after the data we've seen over the last month. Why do you still believe the bar's pretty low for that first move?
Yeah, we've definitely had some pushback regarding the view. I think if you've been following the Fed, though, this is a Fed that wants to get to that first cut. Now, absolutely, the data have not cooperated with that. We've had these 3 stronger core inflation prints. But what we bring it back to is this idea that inflation is higher. We think it is structurally higher, but it is also more volatile. And if it's more volatile, it means we're going to get some stronger prints. We're going to get some softer prints. We've had some stronger prints. We're probably going to see some softer prints. And that will be enough. And I think it goes back to the discussion you were having with the prior guest. Should it be enough? I'm not sure. But it probably will be enough for the Fed to say, OK, we can get started with these rate cuts.
As you know, it's been whack-a-mole over the last 3 months. Every single data point we get, it's like something new is popping higher, and the Federal Reserve needs to talk about why it's going to go lower again. What is it in the basket right now that you see sort of fading, that you see disinflationary tailwinds continuing through 24?
Yeah, so I think there are a couple things that can help the Fed out. And again, I want to emphasize, it's really optically we'll probably get some softer inflation prints. I am pretty convinced that inflation is not returning to 2% in any kind of, stable, reliable way. But in terms of kind of, optically what can help them out, one thing is car insurance. Car insurance has just gone up by leaps and bounds over the last year. That is a real phenomenon. I will say my car insurance went up by, approximately what's reflected in the CPI basket. But we know that auto prices have peaked. Auto prices have actually come down off of that peak. So that's one component that can slow down. That's in core services. That's in that, super core. Shelter, again, there are inflationary pressures that are still there in shelter. We've had house prices that have just really run up. But we should see some slowing, at least in shelter prices over the course of the year. So I think those things should help out the Fed.
Does it make you feel better that the inflation that you're seeing in your auto insurance has peaked?
It makes me feel like at least my lived experience is consistent with the data.
See, right now, just to give you a sense of how much you actually are counter consensus, there's only a 14% chance of a rate cut now priced into the market in June. What's the fear factor for you that if they do go ahead and cut and use any excuse to cut rates in June, it fuels another leg of this rally that we've seen in equity markets, even in some bond markets, that a lot of people argue has contributed to the stickiness of inflation we've seen so far this year?
Yeah, I think those people are not wrong. I think that's a valid concern. And I think that's part of what we're seeing now is we're seeing, some of these PMI numbers that are coming in more positively, some of the corporate earnings that are coming in more positively. We have to think back to what happened 6 months ago. We had a big dovish pivot from this Fed when they really went into this mode of we're looking for the data that can deliver us what we need to see to get to that cut. And we had equity prices that ran up very significantly. That is a big positive stimulus into the economy. That helps to protect growth, but it is doing that at the expense of higher inflation. So I do think that's the risk that the Fed is running.
If the Fed were to cut rates with your base case of 5 times this year, how much does that keep inflation at 3% or 3.5% for the foreseeable future?
Yeah, so to get to the 5 cuts, I think we're going to have to see something weaken in the activity data, in the labor market data. Frankly, we haven't seen that yet. We have a lot of forward-looking indicators that tell us that we may see that later this year, especially in the labor market. But so long as that's not happening, I think the Fed will be a little bit more careful, gradual, as they've talked about. And that would mean maybe cutting rates at a quarterly pace. So you're cutting, 25 basis points in June or July, and then again in September, and then again in December. So, three cuts this year. we have seen equity prices that have peaked and come off of that peak. So I'm starting to feel a little bit more comfortable that maybe we will get some tightening of financial conditions. But absolutely, that's the risk that they run. And that's exactly what's going to be very difficult about this year. Is you're navigating between these two mandates. You have inflation on the one hand, and then you have growth, employment on the other hand. And it's probably impossible to get that balance right.
Matt Lazzetti of Deutsche Bank joins us a little bit later, and he's changed the framing of this conversation around the Fed. He's talking more about mid-cycle adjustments, just a cut here and then a cut there and wait and see, against maybe a backdrop that I think of is a dominating conversation about a rate-cutting cycle, very different to a mid-cycle adjustment. Would you begin to frame it as a potential for a mid-cycle adjustment, maybe away from this more aggressive call of 125 basis points? And what would it take for you to shift from one to the other?
Yeah, that's going to come down to the activity data, to the labor market data in particular. That's where we think that we're seeing some signs that things like hours worked that are going down and part-time jobs that are coming up, some kind of latent weakness in the labor market that we think is going to kind of emerge more clearly in the data. If that doesn't happen, then I think the Fed is talking about this more in the framework of a mid-cycle adjustment. The idea that your Taylor rule would tell you that inflation has come down. If inflation has come down, your real rate is moving up and you just need to adjust lower.
It sounds like the conversation has shifted based on the communication. I think just in the last week, you can feel that shift. And I don't disagree with you. This Fed clearly wants to cut interest rates. But when they start to wander out loud about not being tight enough, to Lisa's point, don't you start to think the conversation on the FOMC is shifting away from we want to cut at all costs?
There's definitely been some shift, and I think that's partly been the inflation data. It's also been the activity data, right? When we get strong activity data, they are telling us that probably doesn't push them to hike, right? That probably doesn't push them to actually move more restrictive in terms of policy rates. But what that does do is it really reduces any kind of urgency, right? That's the other thing that we keep hearing from them. There's no urgency around cutting. As long as there's no urgency around cutting, then you can have these discussions about are we really restrictive enough? How long do we need to stay restrictive? And that's exactly the standard monetary policy cycle, right? You get rates to a level that's somewhat restrictive, then you talk about, is this where we should be? And you wait for the data to show you something. That's where we are now.
Andrew, Mohamed El-Erian was on the show a few weeks ago, and he was talking about the fact that everyone got it wrong in 2021 when it came to this transitory inflation, because they weren't listening to the earnings calls, what the CEOs were saying about actually they had inflationary pressures. Has there been anything in the earnings that you think show that those inflationary pressures are starting to wane?
It's not that clear from the recent earnings calls that you're really waning in inflationary pressure. I mean, clearly we're not where we were a year ago or 2 years ago in terms of very high inflation. But what you are hearing is consumer demand that's held up better than a lot of people expected, particularly on the services side. I think when we get the GDP print, we're going to see this week that goods spending has really been flat or maybe even declining in real terms. Services spending has held up, and we had this wave of disinflationary pressure, which largely came through goods. When you listen to some of those service sector firms, it sounds like they still feel like they have pricing power, and that's really an issue when you're trying to bring inflation down.
My Bloomberg is lighting up with questions for you from different watchers who are thinking to themselves, could this be real? Because we've priced out so many of the rate cuts. I'm sure I can only imagine some of the calls that you get. One viewer asks how much probability you put on the possibility of a Fed rate hike. Is it 0%? Do you basically say that is not on the table despite all of the discussion, even John Williams giving a nod to it?
I think a rate hike this year, so could we eventually get to a rate hike? We could, right? We could stay at this level, and then we could realize that really policy rates aren't that restrictive and they have to go higher, and you have inflation picking up. That's the key is, do you have a real acceleration in inflation? And remember, kind of per your comment, we were at about 5% inflation a year ago. Now we've come down to something that by most measures would be, at least 3 to 4% inflation. We're not at 2, but 3 to 4%. I think that's giving Fed officials a lot of confidence that policy rates where they are at least restrictive.
So 0% chance.
So essentially 0% for this year.
Andrew, thank you. Andrew Honhorst of Citi. This is sounding more and more like post-GFC in reverse. We've talked about this a few times around this table. The calls for cuts now sound like the calls for hikes coming out of the financial crisis in 2009. They were always 12 months away. And it was sort of a rolling 12 months and kept getting pushed back. And I heard Michael Gapin over at BofA sort of flirt with the same idea, talking about 2015 in reverse. 2015 in reverse, where we got that first hike and had to wait another 12 months before we got the next one. This is how slow this process could be.
And it's the reason why there is zero conviction right now when you speak to a lot of people. We don't understand the inflationary regime that we're in. We didn't understand it in the post-GFC where inflation didn't come back. And frankly, I'll speak for myself. It is very hard to understand where we are now, whether we really are in a substantially higher inflationary environment for the foreseeable future.
I think a lot of people listening to this programme equally as confused. Coming up next on the programme, in the second hour of Bloomberg Surveillance, we'll catch up with Darryl Cronk of Wells Fargo, Jeanette Lowe of Strategas, Bloomberg's Craig Trudell, and Zach Griffiths of Credit Sites. Your equity market near session highs, positive 0.33%. Live from New York, this is Bloomberg.
The data could continue to surprise to the upside.
The data is glaring. It's right there. Corporate profitability looks good.
We've had this easy financial condition environment that has basically fostered equity prices, fostered asset prices across the board.
The performance, obviously, of Mag 7 has been unbelievable.
Balance sheets are actually really quite strong. Although the environment is very tough, I think it's also posing quite a lot of opportunities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Navigating weakness in China, the big challenge this earnings season. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance with your equity market near session highs up 1/3%. Tesla, the longest losing streak since 2022. 7 days of weakness. This morning, the stock higher by 0.6%. They report later on this afternoon. Just a flavour of the auto market, Lisa, earlier this morning.
Yeah, we got a sense from GM that things were just great if you focus on the U.S. and you focus on trucks and you put electric vehicles to the side. Basically, everything that Tesla is not right now. General Motors shares flying up almost 4%. Also increasing their forward guidance. What this shows is the distinction between the U.S. market and the rest of the world, that exceptionalism we just keep hearing about.
Will we see that from industry to industry, away from the automakers? Need to talk about tech and the likes of China and Apple. Apple is down year to date by almost 14%, negative by 13.86%, and it's more bad news, this time from Counterpoint Research. Annmarie, iPhone sales in China falling 19% in the first quarter of this year.
This is very worrisome for China, given the fact that China, for Apple, is about 20% of their market, where they should be bringing some hefty revenue from. And at the same time, this is what Enda Curran has said as well. Huawei, in contrast, climbed with their revenue profit 70%. So you could see the Chinese market, Chinese consumers still want iPhones. They're just ditching Apple for a national champion like Huawei.
There's growth there. Bramo, there's growth there, and they're just not getting the market share at all.
So where's Apple going to go? This is what I'm looking for. Are they really going to try to compete in India? Well, they got to pull down the prices. Are they going to try to expand elsewhere? Are they just going to jack up prices in the U.S.? Do they have enough of a monopoly? And oh yeah, what about AI? Can they compete with Samsung as they release their AI feature later this year? It's going to be fascinating. I'm actually really looking forward to this.
Big report coming up just next week. Apple just a little bit softer in the pre-market, down 0.1%. Coming up on the programme through the next hour, we'll catch up with Darryl Cronk of Wells Fargo, with stocks snapping a 6-day slide. Bloomberg's Craig Trudell previewing Tesla earnings, and Zach Griffiths of Credit Sites on why he's sticking with a June rate cut. We begin with our top story. Stocks bouncing back as big tech earnings kick off. Darryl Cronk of Wells Fargo writing this: we reiterate our focus on quality and reduced risk in portfolios and expect to see broader opportunities in US equities over the next 6 to 12 months. Darryl's with us here in New York. Darryl, good morning to you.
Good morning, John.
What are the opportunities right now? Not the next 6 to 12 months, like right in front of me on the screen right now.
I think right now you've still got, you still have to focus on places that have shown the quality leadership: industrials, energy, materials, some of the pro-cyclical nature as the economy does recover. We're fading a little bit more of technology. We think financials may be a little bit overbought here. They've had a really nice run. So I think, you've got to look for those select spots where you're not paying up in valuation. The earnings season will be interesting. So if you look at just quarter over quarter earnings, there's only 2 GIC sectors in the S&P that are going to actually show positive sales growth from last quarter to this quarter. And that's financials and utilities. Everything else is down. And something like tech is down 8% on sales and 20% on earnings quarter over quarter.
This is the equity market. Why isn't the bond market just a screaming buy right now? If I said to people back in December who missed out on the juicy 5% yields of October, you're going to get a second bite of this in March, April time. Do you want it? They'd say, yes, absolutely. Give me a second bite of that. Here it is. People don't come on the programme screaming, buy bonds, buy bonds. Why is that?
Well, 2 points there. One is I do think you're starting to get duration to be a good buy. It's a little bit of equivalent to picking up pennies in front of a steamroller, right? People are grabbing for basis points on the short end of the curve, right? Everybody's crowded the short end of the curve, and you're grabbing for 5, 10, 15, 20 basis points. But if I've got a bond portfolio that has a 8 duration, let's say 7 or 8 duration, and rates do drop 1%, I make 700 or 800 basis points, right? So the point on duration is the right one, right, to start extending here. The most important point, I think, almost entire Wall Street's missing right now is the yield curve has changed metamorphically and nobody's talking about it, right? So if you talk about the 5-year out, we're almost tabletop flat, right? 5, 7, 10, and there's only 5 basis points of difference between the 5-year and the 30-year with just very mild steepness, right? So you're getting a little bit of steepness, the long end of the curve still buying into the soft landing. Where's the short end of the curve? Killingly inverted, right? 3 months to 2 years, 40 basis points inverted. That is tabletop inverted. That's telling you a different story. And a lot of the historical studies that you would look at will tell you that the signal versus noise, the front side of the curve tells you much more information than the back side of the curve or the tail of the curve. So pay attention to the short side because that side is still telling you you got some tougher waters to navigate ahead, which brings us full circle to where we think you'll get some better entry points down the road.
In particular, you said fading tech, which was compelling to me because that seems like actually one of the stalwarts that a lot of people were talking about and that you see more downside to go. Can you talk a little bit about where and specifically you do see that? I mean, is that just sort of focused on the Tesla Apple stories that we were talking about, or is this a broader just, things have gotten overbid, valuations are too high, they got more room to fall?
I think a little bit of the latter, right? I think the valuations are stretched here. I mean, when you look at tech, I mentioned a moment ago about, 20% quarter over quarter drop in earnings, 8% decline in revenue. So they're going through some challenging times. Lisa, I think what people are also missing under this heading of kind of big themes and changes, massive change inside of tech over the last 6 to 12 months, which is everybody now, and we think investors should be chasing hardware, right? There's been this big shift from capital light, software intensive, cloud, to now it's all about, AI data centers, hardware, even the big Googles, the Microsofts are investing, hundreds of billions of dollars in that type of thing. That's a durable trend, we think, for the long term. So within tech, if you're going to get exposure, I think people are still missing the kind of inflection point we've hit from the last 10 to 15 years of software and capital light basically being all the rage. I mean, think about Google. Google started with $100 million and 1,000 employees, right? And has probably become one of the greatest firms on the planet, right? Now it's going to be all about who can invest the most money in hardware and infrastructure to build for that next generation.
It strikes me that everyone who comes on this show has less and less conviction as time goes on. When was the last time you had this little conviction about the direction of travel for prices, not necessarily for some of these larger stories of what to look at?
Yeah, so here's what a little bit goes back to John's point. I think what you're starting to see, and I think Andrew talked a little bit about this on the prior segment, there's this bifurcated economy out there, right? And some have talked about it, the high-end consumer versus the low-end consumer, big business confidence versus small business confidence, right? Tech manufacturing spend versus non-tech manufacturing spend. Services versus goods, right? So you've got to think about when you're putting your investments in places, I'm oriented towards those places where strength resides, right? And I'm fading those places where the weakness is at, right? The reality is there's still just so much liquidity you guys talk about all the time in the marketplace. It's driving all asset prices higher, right? Regardless. I mean, look this morning, the FTSE setting a new all-time high, German DAX at an all-time high, Nikkei overtook 4,000. You got gold at 2,400, right, which is typically a risk-off asset. S&P was sitting on all-time high, credit spreads at tights, right? There's just liquidity chasing everything. Doesn't matter if it's risk-on or risk-off assets at today's level. So at some point that starts to separate and you start to understand, okay, where do I really want to have exposure over the next 3, 6, 9, 12 months? And we think that bifurcated economy theme continues to play.
And around the world, where do you want to have exposure? I know you love the U.S., and
Yes.
you're shrugging off EM, but where in the developed world?
I think if you're going to have exposure in developed world, you still want to be Japan is probably the best country there. It'll be interesting to see if the BOJ has to intervene here at some point to defend the yen on a 34-year low this morning.
We thought 152, then 153, then 154, and now we're basically at 155.
Yeah, I think you've got a bunch of you've got the PBOC that is trying to defend the red line on the Chinese yuan. You've got the BOJ trying to defend the yen. But equities there are doing phenomenally well. And I think Europe is an interesting case. It's a little hard. You almost kind of have to look the other way and hold your nose a little bit, right? When you go to invest in Europe, because when you drill down into the fundamentals, you're not going to see particularly great things. But the markets there continue to do well. And I think for the first time maybe in a decade, you might have this case where developed markets start to challenge the U.S. The first quarter, most people don't realize, developed market equities actually outperformed the S&P by 0.2%. It wasn't by a huge margin, but first time in a long time.
The psychology around Europe always makes me laugh. I remember when I first moved here and someone said it's good for vacations, terrible for investments. And I think people still feel that way about Europe. When you're looking abroad, you're thinking of two things right now, I think, at the moment. One is the strength of the US dollar, and the other is what's happening in China and how and if I want exposure to that story. How are you navigating those forces at the moment?
Yeah, the king dollar is just, we talked about 34-year low on the yen. Against the pound sterling, it's really troubled. The euro is weak. The Chinese yuan is weak, right? There's just no good place to be there from a currency standpoint, probably that makes sense unless you're just deep value hunting. It's interesting, to your point on China, John, if I go back and look at China over the last 2-3 decades, China's never been a good investment. It's been a good tactical trade, right, at moments in time. But if I pull out any, give me a Chinese indice and show me the last 20, 30 years, and I would show you that it's not been a great, sustainable, durable investment, right? Something has to inflect and change there to get us terribly interested there, notwithstanding second largest economy on the planet. So you always, as a lot of people have done over the years, you can play China indirectly without having to have the direct exposure to China. So you play the benefits of the Chinese economy spilling out into the global marketplace.
Just before we let you go, this is a massive week. We get a lot of earnings. Tech earnings really kick off. We get PCE as well as personal spending and income on Friday, and then we get a host of auctions, including today's record $69 billion of 2-year notes being sold at 1 p.m. What do you think is going to be most instructive for you to get a sense of whether we're starting to inflect to that divergence that you've been expecting?
Auctions are always key, right? Because it's the theme of liquidity, right? You hit on this all the time, right? And the bid to cover ratios have been weak. I guess if I'm watching one thing there, it's not PCE on Friday because we think we kind of know where that's going to come in, 2.7, 2.8, and you're still a full point difference between CPI. It's earnings, right? We get 30% of earnings this week, which puts you at the 50th percentile mark. If I were to say what's a theme of earnings season so far and what we've seen for about the quarter of the market cap that's reported for the S&P, it is this. It is weak topside demand with a good defensive margins at this point, right? So it's a good news, bad news, right? You can clearly see demand is softening and weakening. Companies are doing a great job controlling the cost line and defending that margin line, but you can only do that so long. You do need top line growth to keep driving. And so if we're going to get to this 11.5% consensus earnings, bottoms up, top down, that everybody believes the S&P is going to give us this year, we got to go. We got to get the engine humming here because first quarter is not looking particularly good. It's looking more like a flat to maybe slightly up, 3-4% on a beat.
We got to go. Darryl, this was solid. It's good to see you. Darryl Cobb there of Wells Fargo. Equities at the moment positive by a third of 1%. Let's get you some stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. I'm sure this will come as a shock to you, but JP Morgan's Marko Kolanovic is warning a further downside in stocks. He wrote to clients yesterday saying that the slide is just the start of a sell-off that he thinks is likely to get worse because of macro risks alongside higher yields, a stronger dollar, and elevated oil prices. He, of course, has been calling downside for some time. And he also added that, yes, U.S. earnings could temporarily stabilize the market, but it doesn't mean that stocks are out of the woods. Shares of JetBlue lower in the pre-market trade by 7%. They forecast second quarter revenue falling by as much as 10.5%. It saw full year revenue down in the low single digits. The airline said that, quote, significant elevated capacity in our Latin region will likely to continue to pressure revenue, and we expect a setback in our expectations for the full year. Amazon has introduced a new grocery delivery subscription, priced at $9.99 for Prime members. The subscription offers unlimited grocery deliveries on orders over $35 from Amazon Fresh, Whole Foods, and some local grocery and specialty retailers on Amazon.com. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for bringing up the Marco note as well. The list of concerns in that note yesterday, here's a flavour of it. Concerned about continued complacency and valuations, inflation staying too hot, further Fed repricing, and a profit outlook where the implied acceleration this year might end up being too optimistic. It's a long, long list from Marko Kolanovic over at JP Morgan. Up next on the programme, the Senate taking up the foreign aid package.
The aid package certainly passes. There's also an awful lot of sanctions and foreign policy matters that pass. Beyond that, on TikTok, I don't think, honestly, we know yet.
That story up next, live from New York this morning. Good morning.
Earnings season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been? Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Lots still to come this morning. 9:45 Eastern Time, we'll get US PMIs. Bramo went through the auction, $69 billion of two-year notes coming a little bit later on this afternoon, and earnings from Tesla after the closing bell. Going into all of that, equity futures positive by a third of 1% on the S&P. Yields a little bit higher again by a basis point or two, 462.51 on a 10-year maturity. Under surveillance this morning, the Senate taking up the foreign aid package.
The aid package certainly passes. Ukraine, Israel, the Indo-Pacific, read Taiwan. There's also an awful lot of sanctions and foreign policy matters that pass. Beyond that, on TikTok, I don't think, honestly, we know yet.
Here's the latest this morning. The Senate voting on a foreign aid package for Ukraine, Israel and Taiwan, as well as a bill forcing TikTok parent ByteDance to divest the platform or face a ban in the United States. Jeanette Lowe, Strategas, a Baird company, joins us now for more. Jeanette, it's going through the Senate. Can you walk us through what you think will pass and what won't?
So we actually think that everything is going to pass the House. So there's going to be the package for Ukraine aid, for Israel aid, and for the Indo-Pacific, as well as this other, what they've been calling a sidebar package that includes the potential ban of TikTok if it does not divest from ByteDance. It includes the Repo Act, which allows the U.S. government to seize Russian assets and use those proceeds to pay for rebuilding of Ukraine. It includes Iran oil sanctions on vessels and ports that help transport Iranian oil. All of those things we actually do think gets through the Senate. This was a package deal. The House put everything together to also try to force the Senate to vote on some of these things. As we all know, the Senate has been holding up a vote on the TikTok ban. The House deliberately put it into this package to make sure that the Senate would vote on it. And that's why we expect everything to pass this week in the next day or two.
Do you think we could see any amendments, though, to this large package?
I think it's pretty unlikely. If they did do any amendments, would have to go back to the House. The House is technically currently on recess. That would mean you'd have to pull them back. We already had a lot of turmoil in the House just to get this package done in the first place. That would just create more turmoil. I don't think that's what the Senate is looking to do. They're looking to get the Ukraine aid package out the door. And I think that they're willing to support all of these other pieces, even though there would probably be some changes that certain members might like.
One provision in this package is the idea that the president can apply sanctions more sharply when it comes to Iranian oil. But Jeanette, do you think in actuality that's going to happen with this Biden administration?
Right. I mean, so one of the things that's important is this. So this is a bill that it's called SHIP Act that was included in this foreign aid package. It had passed the House previously last fall. In the fall, that bill had a 90-day window for it to be enacted. That was now increased to 180 days when it was included in the foreign aid package. That means that if it was to go into effect, it would basically butt up right at the presidential election in November. So we don't expect any push on sanctions before the election. This might be something that the president can then do afterwards. We'll kind of see how the geopolitical situation is then, and maybe things might take a turn at that point. But right now, they've kind of set it up so that we really don't have any impact on oil sanctions before the election, and so it doesn't hurt the president's numbers.
It seems like a lot of people are expecting the only big move to come from the Biden administration ahead of the election is a slew of tariffs to come against Chinese goods in particular. Do you expect that the recent trip by Tony Blinken to China, I believe he leaves today, is going to yield or pave the way to some of those tariffs that people have been talking about?
Right. So, I mean, Secretary Yellen, when she showed up in China, I believe a week or two ago, this is one of the things that she was kind of focused on, that China is trying to export more of its surplus right now. And that could lead to a lot of dumping, not only in the United States, but also in other countries. And then you had President Biden say that he wants to increase tariffs on Chinese steel and aluminum. A lot of other countries are also concerned about what might be coming out of China, what those low-cost exports will then mean for their own domestic economies. So I think that's going to be on the radar screen. Blinken, I think, also in part is trying to focus on the fact that China is trying to supply Russia with some material that helps its war against Ukraine. It also wants to focus on some of the other issues that they've had in the relationship. So tariffs may not be something that goes into effect as quickly. We had the U.S. Trade Representative say that she wants to apply solar tariffs, but I don't think you're going to see as large of an impact from that. But this is kind of the constant dance that we're having with the U.S. and China, where they're talking a lot, but at the same time still taking lots of actions against one another, and that is going to continue.
How much do you think that the pressure of the election, of the potential that President Biden is not going to be the president after November or after the transition date in January next year, that's actually bringing Europe and the U.S. together in a way to come up with some sort of cohesive plan against China, which we hear bandied about a bit in a number of places?
So it's interesting. I mean, one of the things that we do think when we look at this election is we think about whether or not it's not whether we're going to deglobalize or whether we're going to pull back from China, but rather the extent to which we would do that. Obviously, President Biden is much more willing to have alliances, really work with our European partners, work with others around the world to try to get the same policies in place with regard to China. Trump is much more of a go-it-alone style. So I think you'll still see hawkish moves with regard to China if Trump becomes president again. But Biden is really kind of working on trying to build a foundation, having alliances, having similar structures so that the policies will be more impactful. And I think that the Europeans, at least in this current effort, are trying to play along to some extent, trying to be on the same page as much as they can, though I think you also kind of do see some other things because you had the German chancellor go over to China and then was also focused on business deals as well. So there's a little bit of straddling that has to be occurring. But I think that especially with regard to Ukraine, that's where the biggest concern that the Europeans may be having about whether or not Biden is still in office or whether Trump is in office and whether any aid for Ukraine would continue.
Jeanette, that's exactly where I wanted to go. How awkward is it for Blinken saying that they are going to have this multilateral approach, the Europeans are on board, but oh wait, are they? German Chancellor Olaf Scholz was just there with a ton of German executives, what looked like a very friendly meeting to make sure that trade continues, even though we all know that China is helping Russia in their war effort.
Right. And so this is something that they are definitely having trouble probably straddling. Blinken has been trying to be rather forceful, with being the representative of the United States to try to bring the partners along. But you do have these, Europe doesn't want to be seen as just towing the line that the United States proposes. But at the same time, there is this dichotomy where it seems like China is able to maybe woo France, woo Germany to try to have some better trade deals, better business opportunities. opportunities, but yet the U.S. is continuing to push to move away from that. So this is definitely a delicate balancing act that he has. Obviously, I think that his hand would be stronger if there was a much more forceful effort, but the U.S. is definitely going to continue on its path. There is going to be this continued decoupling from China, both from the administration, both from Congress. And I think that they just need to see how they can get the Europeans to get on board slowly but surely.
Jeanette, thanks for joining us this morning. Appreciate the input. Jeanette Lowe there, a strategist on the latest developments down in Washington, D.C. Given how divided Washington is right now, I think for a lot of people in this country, it's kind of surprising that we've managed to find an agreement on foreign aid. And we're sitting here and we still haven't got any agreement whatsoever, or dare I say, even a conversation about addressing what's happening on the southern border.
Yeah, well, that's very true, Jonathan. But I think what you saw at the House of Representatives, they knew if they put the southern border into that agreement, then the whole package would have been blown up.
Coming up on this program, the not-so-magnificent Tesla kicking off Mag 7 earnings. The stock down close to 43% this year. Bloomberg's Craig Trudell joining us on the other side very shortly. Equity futures positive by 0.25% from New York. This is Bloomberg. Welcome to the program. Equities positive by 1/3 on the S&P. On the Nasdaq, positive also, up by 1/3. On the Russell, the small caps just about unchanged. JP Morgan, Marko Kolanovic says this sell-off's got further to go. Even with that bounce yesterday, I went through the long list of reasons as to why this sell-off's got further to go. Lisa, let's talk about them. Complacency and valuations, inflation too hot, further Fed repricing. I'm not sure how much more you can reprice the Fed, but okay. And a profit outlook where the implied acceleration this year might end up being too optimistic.
Well, look, Marko Kolanovic is a divisive person, and people can target some of those things. I want to just stick on the earnings issue, because we heard that from Daryl Cronk, too. That basically, if you look under the hood of earnings that have come out so far, what they show is there is a more tepid consumer, and that they're managing it on the other side in terms of corporate executives by cutting costs. We're seeing that at UPS. We're seeing that in other places, too. JetBlue had a rough time. So that, to me, might be the standout aspect of this earnings season.
JetBlue needs a rebrand. Said that a million times.
Yeah, so what do you think they should be called?
Catch up with JetBlue. JetBlue just gives people the impression they're a budget airline, when actually JetBlue is actually really, really decent service when you get on board. There's nothing budget about it.
So what would you call it?
I'm not sure.
You call it, Jet Extravagant.
Just
Jet Jimmy Choo.
It just needs a rebrand. That's why I never understood the potential acquisition between them and, was it Spirit?
Well, Spirit is its own ball of wax.
That's sort of like turning up the volume on being budget, right? You're going after Spirit.
Honestly, though, if people can't get new planes, that basically you're going to have, a questionable ceiling, then potentially, budget's okay. I agree with you. But at the same time, JetBlue is trying to cater to the family that wants to go on vacation to a warm island, which feels really nice right now, sounds it. But to me, it sort of raises this question, what kind of appetite is there for that type of travel? And we're seeing a bit of a diminished capacity and a diminished demand.
I'm not sure how we got there, but more on the JetBlue rebrand a little bit later this morning.
With your JetBlue rebrand.
We're not.
Carry on.
Equities are positive by 1/3. Switch at the board and get to the bond market. Yields a little bit higher by 2 basis points. On a 2-year, 4.9913. Just in and around 5% going into PCE. This is the wait and see. Bob Michael, JP Morgan Asset Management. This program yesterday. Wait for PCE. Wait and see. Look for a washout into month end, then start to buy fixed income again. How much more yield do you want at the front end of the curve?
How about 5.5%, and then I'll buy? No, look, this is really the key question. Yesterday, people were saying that the reason we didn't stay above, the reason why we saw some sort of bid to equities is because we didn't see that 2-year yield stay above 5% for any protracted period of time. Let's wait till 1 p.m. today. I actually think that might be more interesting when we get $69 billion of 2-year notes that are sold. How easily is that digested at a time where you even have the likes of Bob Michael, a big bond bull, who's on the sidelines waiting for PCE?
More supply coming tomorrow and the day after as well, going into PCE on Friday. Let's turn to foreign exchange. The bulk of G10 right now, just looking at the screen on my terminal, the bulk of G10 positive against the dollar. Bear that in mind when you look at the euro. The euro's positive by 0.1% at 106.71. Data better than expected, but just talk about the relative low bar, better than expected. PMIs have been dreadful for months, Bramo. They're starting to look better. And you pointed out the distinction. It's not manufacturing. It's services doing the important heavy lifting.
Which raises a lot of questions to me, especially for Germany, because that's the manufacturing hub of Europe. But it's definitely bifurcated. So it's good, but is it good enough to be sustainable, especially for the largest engine of growth, supposedly, in the region?
The euro just about positive positive. Under surveillance this morning, our top stories: a first Senate vote on the foreign aid package set to take place today. The package includes aid for Ukraine, Israel and Taiwan, and a bill that would force ByteDance to divest from TikTok. President Biden telling Ukraine Zelensky aid will flow quickly if the Senate approves the package. Annmarie, base case today, approval or no?
It looks like base case it will be approval, or potentially this bleeds into a little bit later down the week, but it's going to happen this week. It looks very likely. And then with President Biden getting on the phone with Zelensky saying we can get that aid to you quickly, the administration has been preparing for this moment, so they really can get it out the door quickly. And one U.S. official speaking to the Financial Times recently was talking about the fact that a lot of these supplies are right over there on the border in Poland. So the second they say the Senate confirms it and you have Biden's signature, that ammunition is over the finish line.
As soon as that happens, is TikTok shelved as an issue? Is it something we no longer talk about? Does it just sit there for the next 12 months?
No, I think we're going to talk about it around this table, but they'll have a year. They have a year to deal with this. And that basically means you'll start talking about it after November 5th.
I love this. Honestly, it's politically brilliant. You basically say, we're going to deal with it, but we're going to push it out. We've dealt with it, so it's not a problem. Don't worry about it, but you're still using TikTok, so you can't complain about that either. Hallelujah.
It's beautiful.
It's really, it's
Then they start to appeal, and as the president, you say it's in the hands of the courts.
100%.
I've done my bit. I signed the bill.
Basically, this extension of time frame. Mwah. Political brilliance.
Did you see what the former president said about it? The former president, Donald Trump, who, by the way, tried to do exactly the same thing, was then basically saying, just remember, when you lose TikTok, this is why you lost TikTok. Politics drives me insane. Have I ever said that before? Drives me insane.
Stick to the rebrand.
OK, let's turn to Apple. Shares of Apple falling after the iPhone sales in China fell 19% in the first quarter, according to data from Counterpoint Research. Apple resorted to rare price cuts in the region in January to spur demand, apparently not working out. The stock, Annmarie, is down a third of 1%.
Demand is there. Huawei sales up 70%, while Apple sales are moving backwards. This is a huge issue for Apple, and I don't think it's about the consumers don't like this product. This has to do with nationalism and the fact also that in Beijing, if you work in a government office, actually you can't use an iPhone. So the message is there on the wall for these Chinese consumers, and I think that's why you're seeing a lot of that demand shift to Huawei.
This has been building for a while. I don't think this is new. We're just starting to see it in a much greater way. I think we spotted this, and to your point, as soon as you start to see the government organisations start to ban the use of the iPhone, we knew where this was going. And now you've got some decent competitions from the likes of Huawei. This is the point that I think you raised earlier, Lisa, that I think is the most important point. The fact that there is a market that is growing and they're getting a smaller and smaller slice of it is a big problem. It's not like EVs for Tesla, where EVs more broadly are struggling. The smartphone business in China is not a struggle right now. There's growth there. They just can't penetrate it.
Which raises the question, are they going to start saying the quiet part out loud? Last week when we were at the IMF meetings, it was the quiet part that was actually being spoken out loud. For Tim Cook over at Apple, there's been a question, how quickly can you move manufacturing out of China? How much can you reduce your footprint? How much can you basically count out growth in that region? Will he be forced to really address that at this point? Because frankly, it looks like there's real competition. So suddenly he has to start thinking, OK, well, what's my growth market? Is it India? Is it pockets of the U.S. that we haven't penetrated yet? These are the types of conversations that finally people are starting to have out loud.
That's Apple. Let's talk about Tesla. A massive report coming after the closing bell a little bit later this afternoon. The company cutting prices, shedding staff and facing waning demand for its EVs. The stock is down close to 43% so far this year. Bloomberg's Craig Trudell joins us now for more. Craig, wonderful to catch up with you, sir. You said it. Get the popcorn out later on this afternoon. What's the big one for you? What are you focused on?
Well, I think there's been so much noise around this stock and a lot of attention around that noise, and for good reason, with the strategic changes that Elon Musk is wanting to push through. But we shouldn't lose sight, too, of just the fundamentals and to what extent, the noise and the collapse of the fundamentals are sort of, interplaying with one another. Is the fact that revenue and earnings and gross margin and free cash flow all trending in the wrong direction, leading to Musk, taking these drastic measures. And, to what extent is that, just going to become a sort of, a self-fulfilling, cycle that we get into, where as earnings, underperform, does Musk, go even more extreme and rattle people all the more?
Craig, I remember, was it Wells Fargo who talked about how do you value a growth company with no growth? Craig, is that what we're going to hear later? Basically, the prospect of no growth for the next 12 months and a carrot over the stock, which is Robotaxi's announcement later on this year.
Yeah, I mean, I think in the past we've seen, the stock work really well when we've had an event, months out to get excited about. I think back to the year 2020 and when Tesla scheduled Battery Day for the fall of that year, the stock just absolutely ripped going into that event. It helped, of course, that they were scaling up the Model Y. But this is, a very different company at this juncture. This robo-taxi coming in August is maybe something to be optimistic about. And yet there are real questions about, just how real that is when this CEO has been talking about robo-taxis for, going on 8 years at this point. And so how real is it? How soon can they commercialize it? What the risk is in terms of execution and regulatory approvals. All of those things are really difficult for the street to get their arms around.
Craig, I have my popcorn out, and it's not to look at margins. It's to really see which Elon Musk comes out. Is he coming out swinging? Is he going to be aggressive? Is he going to try to put on corporate executive suit and come across like a diligent executive? How important is it, the tone in which he takes at this press conference?
I think that's a really good question. We joked during the break about this idea that in the past, this is a CEO who's referred to analyst questions as boring and boneheaded. When that happened, the stock did not perform well the next day. I think, there needs to be, some understanding that, what he's trying to do here is really, kind of out there and difficult to kind of wrap your head around. And if there's just a sort of, you guys don't get it, but this is, blindingly obvious, I don't think that's going to be well received. He absolutely needs to sort of change the narrative around, can this company grow or not, to the previous question, and can it grow without new product? And I think that's one of the other things that everyone's come to grips with is, this quote unquote Model 2 is not coming. It is definitely not coming soon, and it may not be coming for several years if it comes at all.
The divide between bulls and bears on Tesla often is this a car company or is this something bigger? The cult of Elon Musk gone extreme. How much have we had the cult of Elon Musk sort of priced out of the shares over the past 40% decline that we've seen so far this year?
I think it's still priced in there. The stock is absolutely getting beat up, but this is still the world's most valuable car company, despite the fact that it's still much smaller than, say, a Toyota. And so there is some room left for this to go lower if the street is not able to get comfortable with this idea of stopping the bleeding in terms of the fundamentals of the business and growing again. And so there absolutely has been some shine lost over the last few months, but this is still a company that's valued very richly in terms of forward earnings.
Well, Craig, doesn't that just bring up the point that this is an industry-wide problem? And I looked to GM earnings this morning, and their primary driver of growth was sales of trucks. And it didn't really matter what they did in China because they were driven by this insatiable demand in America for gas-powered SUVs. Isn't that the problem Tesla fundamentally is facing?
I think that's absolutely right. And when you compare how this company is performing relative to manufacturers that are still making gas cars, more importantly, big gas trucks and SUVs, I think we're seeing GM and Ford perform really well. We're also seeing Toyota. I mentioned earlier the hybrid strategy that they've very much stuck to, despite the real criticism of are you guys going fully electric fast enough? They really kind of stuck to their guns and were stuck in on this goal of electrifying, but doing so in a sort of piecemeal fashion, going along with the consumer. And lately that really looks like it's paying massive dividends.
GM high this morning by more than 4%. Tesla has struggled over the last week. Craig, thank you, sir. Craig Trudeau out there breaking things down on what to look for from Tesla later on this afternoon. Remain in the team. We'll break that down after the close a little bit later. Equity futures on the S&P positive by 0.25%. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The FTC has sued to stop Tapestry's $8.5 billion takeover of Capri. It alleged the deal between the owners and licensors of Coach, Michael Kors, and Versace would raise prices in the affordable luxury sector. It's the first time the Biden administration has used antitrust enforcements in the sector. More problems now for Boeing. It faces supplier shortages on key parts of its Dreamliner aircraft. This comes from Reuters, who reported that Boeing expects a slower increase in 787 production and deliveries. Boeing, for its part, says it was producing 5 Dreamliners per month in the last quarter of 2023, and it still does plan to steadily increase deliveries due to strong demand. Apple is getting close to inking a deal with FIFA to get worldwide television rights for a new month-long World Cup-style tournament in the U.S. That's according to the New York Times. It would be Apple's latest venture into soccer following a 2022 deal when it secured a 10-year contract for the worldwide streaming rights to Major League Soccer. That's your brief, John.
Danny, thank you. Up next on the program, the case for buying bonds.
We're really close. We're really looking at levels both in government bonds, more importantly in credit, and we feel this is a pretty good opportunity to get in.
Our next guest looking for 375 year end on a US 10-year. That conversation up next. Equities positive by 0.2%. Check out the bond market. Yields higher by 3 basis points on a 10-year maturity, 463.75. Under surveillance this morning, the case for buying bonds.
I'm trying to hang on to all my fingers and toes and keep my discipline into month end. This feels like a real month end washout. You also still have a lot of investors wanting to take profits, or a lot of momentum investors yet to cash out. So we're really close. We're really looking at levels both in government bonds, more importantly in credit, and we feel this is a pretty good opportunity to get in.
That was Bob Michael at JP Morgan. Here's the latest this morning. Treasury yields holding near year-to-date highs. Traders awaiting a flurry of Treasury auctions and Friday's PCE data. Our base case is the Fed begins cutting in June and delivers 100 basis points of cuts this year. We view several drivers of recent upside inflation surprises as lingering COVID effects and not indications of broad demand pull inflation. That quote from Zach Griffiths, the head of IG and macro strategy over at Credit Sites. And I'm pleased to say that Zach joins us right now. Zach, you've got a target at 375 year end on a 10-year. So you're bullish bonds. Walk us through why.
Yeah, John, we think that inflation is going to continue to come down, and perhaps more so in the second half of this year. That allows the Fed to start bringing the policy rate lower in a manner that doesn't really adjust the real policy rate majorly. It just takes it down in line with inflation. And so we think that with that, given what the market is pricing right now, that would cause yields to fall quite a bit relative to what's priced by forwards at this point.
So, Zach, are you looking for that classic sort of bull steepener? Is it economic weakness that leads to those cuts? And I would have to ask sort of how many cuts, because, Zach, only 2-3 months ago, 3, 4, that sounded almost, I would say, hawkish relative to what the market was priced for, which was 7. And now we've closed that gap, and 2-3 just sounds really, really dovish, Zach. So what do we get?
It's been a huge swing, John, and we're expecting 100 basis points of rate cuts this year, with the first one coming in June. And we think that bull steepens the curve more than the market prices right now. We're looking for the curve shape to be about 25 basis points on 2s, 10s at the end of this year. And it really comes down to economic growth falling below potential. The Fed expects it to remain above potential. We were surprised to see that adjustment to the summary of economic projections. And so we think with that below potential economic growth backdrop, you have another leg lower in inflation that allows the Fed to start normalizing policy, not in a way that takes it back to anything that looks accommodative, but just moving back toward neutral by the end of this year.
Zach, I wonder if underneath your projection, there is a belief that we are going back to an inflation rate, just a base rate in this economy, similar to what we saw before the financial crisis, basically 2%, but nothing extraordinarily high.
Yeah, Lisa, that's our base case. We move back to around 2.25% at the end of this year, and maybe we're not all the way back below 2% at an extended clip like we were in the 2010s expansion, but something in the 2 to 2.25% range we think is a win for the Fed. And so when we expect the policy rate to move back toward that 4.5% by the end of this year, that's really not a real policy rate that's anywhere near neutral in terms of going back toward the 0 or very low level that we experienced in the 2010 decade.
That view would suggest that the current rate is sufficiently restrictive and then some, right? And I do want to go into this kind of concept. What are you seeing in the economy that gives you any sense that we're actually constricting growth with rates where they are currently?
I think it comes down to what you're seeing in the lower income and lower wealth cohorts of the economy. You're starting to see some of the fiscal buffer come out. And when we listen to earnings calls or check in with our analysts that are listening to the earnings calls, we're starting to see a normalization in consumer spending trends and an uptick in value-seeking behavior. And so we're really looking for the U.S. consumer that's been the engine of growth since COVID. We're at about 1 percentage point above the trend line pre-COVID for personal consumption expenditures, while we're about 1.5% below the pre-COVID trend line in terms of the economy overall. We're just looking for a normalization there, and we are starting to see signs of that, especially as we go through the consumer side of the economy.
Zach, you're a credit guy. What typically happens? Can you do some scenario analysis? What typically happens to credit when the curve starts to bull steepen? And is there any reason to believe that this time is different?
It's a positive backdrop for credit, John, and we are expecting that bull steepener is generally conducive to a carry environment for corporate credit. So we're not looking for a lot of spread compression from where we are today. Our year-end targets on investment grade are 100 basis points, and for high yield, we're at 350 basis points. So that's unchanged from where we were coming into 2024. I'd say some of the performance that we had expected this year got squeezed out at the end of last year and in the first couple months of 2024. So not looking for a ton of further spread compression from where we are today. We do have a scenario where we get all the way down to 75 basis points on IG and 275 on high yield, but that's not our base case.
The way I typically think about it, Zach, is that typically when you get a bull steepener, which is basically the front end rallying more than the long end, it's off the back of a rate cutting cycle that's triggered by economic weakness and generally not conducive to equity markets and risk assets doing well. Am I thinking about it the wrong way?
No, you're not, John. But when we think about what we're going to see at the end of this year, it's more of, I think you were talking earlier on the show, a mid-cycle adjustment in terms of policy. So we're not really looking for a rate cutting cycle going all the way back to zero. We might not be all the way back to accommodative by the end of this year, certainly maybe not even by the end of next year. And so when we think about these rate cuts, it's more of a policy normalization, a recalibration to recognize that the economy has normalized a bit coming out of COVID. We have growth slowing below potential, and we just don't need a policy rate as high as we've been at. And if you look at just how much inflation has come down with above potential economic growth, if we start to get that below potential growth, we think it comes down more meriting an adjustment to the stance of policy.
Just for the sake of scenario analysis, let's say the market's right and we only get 1 or even 2 rate cuts this year. What does credit do?
We think spreads widen a little bit from where we are today. We could see IG moving to 130 basis points, maybe a move up to 500 basis points on high yield. So not retesting the recent wides, but a drift wider. And so I think that when you consider policy not adjusting the same way that we're expecting, it will cause spreads to drift a little bit wider. And that concern that we all had coming into 2023 about a hard landing, I think comes into greater focus if the Fed leaves policy more restrictive than we're anticipating. I think the big driver here is, does inflation come down as much as we anticipate? If it does not, perhaps the market pricing is correct, and you don't necessarily have to have a huge recalibration in terms of spreads.
If there is that situation where rates stay pretty much where they are, just go down just a touch, that mid-cycle recalibration, do we start talking about wait until 25 or survive until 25 one more time? And this idea of the companies that finally have to refinance at rates that become punitive for their leverage structures created in a very different rate cycle?
Yeah, survive till 25 is one we've heard a fair bit. And when you think about some of the deals that have gotten done this year, I think investment grade has done incredibly well. We've seen a huge amount of deal flow, and we've even seen that in high yield with the lower rated market opening up quite a bit. And so I think so far, even with rates staying elevated and the expectation that rates could stay elevated for quite a bit longer, we're getting deals done at good execution and tight ends of initial price talk. And so I think so far concerns on the primary market side aren't there. Maybe that picks up if we get to the end of this year and we have no rate cuts, but that's not our base case. I think that does come back into play and probably has a bigger impact in the high yield market than investment grade around the end of this year, moving into 2025, Lisa.
Hey, Zach, this was interesting. Always great to catch up. Zach Griffiths there of credit size, looking for 375 on a 10-year by year end. 10-year right now, 464, looking for something like 100 basis points of cuts coming through this year and some steepness breaking into the curve. Coming up in the next hour, just want to go through this lineup for you. Mike Wilson of Morgan Stanley, George Ferguson of Bloomberg Intelligence, Matt Lazzetti of Deutsche Bank, Vijay Rakesh of Mizuho. We'll talk to Vijay about the earnings coming a little bit later from Tesla. Need to talk to Matt Lazzetti about something that Zach just alluded to, the prospect of a mid-cycle adjustment, maybe one cut at the end of the year, December. That's the call from Deutsche Bank. And maybe you've got to wait a while to get another one.
This is the world going to Stephen Stanley's way, right? If that's basically what he was talking about months ago. Here's a question. If that's the case, how many market assumptions are just wrong? Because that's not exactly the Goldilocks that everyone was talking about with enough rate cuts to really fuel another leg of this rally. A really curious moment where we're really getting such disagreement on the paradigm we're in. Are we in a highly inflationary one, or are we in the Zach Griffiths world of going back to where we were before?
I want to get into Mike Wilson's world in just a moment over at Morgan Stanley. My favourite notes on the South Side are when they put out a note and ask themselves their own questions, because then I just go through the note and write the questions down. Don't you do the same thing? I want the answers.
Okay, all right, but he gives the answers.
My favourite question in the note was, are we early cycle?
Yeah.
Given the amount of rolling corrections we've had.
It's
a conversation we can have next.
And he answered it.
Yeah, and he can answer it some more. Isn't it worth talking about? I think it's worth talking about.
Yeah, maybe he needs a brand,
The third hour of Bloomberg Surveillance up next. Are you suggesting he needs a brand?
No, I'm saying that you're in the business of doing that right now.
For airlines, not for strategists.
We can discuss.
The market's going through a transition right now.
We've had so many people chasing these rate cuts, chasing these higher valuations, that I think we're due for that correction.
It's impossible to believe they're going to hold rates at these levels forever. But the timing question is a big one.
Higher long-term rates are something we can learn to live with.
You can live with slightly higher inflation and a slightly higher Fed funds rate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now, and earnings season kicks off in a much bigger way later on this afternoon with Tesla earnings on deck. From New York City this morning, good morning, good morning. Your equity market positive by 0.2% on the S&P 500. The fate of this market this week, not in the hands of Fed speak. Isn't that a beautiful thing? They're in a quiet period. In the hands of tech earnings through the next couple of days.
Especially given the fact that that has been the area of so much angst over the past couple of weeks with the pullback that we've seen. Just the dissonance between all of the tech earnings are going to be interesting. The Tesla Apple story, very different from the Microsoft Google story. And that's, I think, what a lot of people keep talking about.
We've talked about it through the year so far. The not so magnificent Mag 7. And two of those names jump out. One's Tesla, another's Apple. Both down by double digits so far year to date. And those two names both speak to one theme: the struggle for US tech firms in China.
It's a huge struggle right now for Tesla and for Apple. And Apple overnight, the data we got ahead of these earnings is that they're seeing this weakness in China. What is so remarkable, too, is it comes as China was celebrating the Lunar New Year, when people would normally go out and buy things like iPhones. And then Huawei sales, they're up 70%, while Apple's down 19%. The demand is there. The issue is doing business in China.
I'm actually more interested in the 493, the forgotten 493 as people talk about it. Because frankly, that's going to give you more of a sense of where the consumer's at and how much pushback you actually get. So far this morning, the likes of GM with American exceptionalism, the likes of UPS with cost cutting and efficiency. These are interesting stories. The story that they tell together, very confusing. So good luck with that one. But it definitely gives you a sense of just some of the cross currents and the rolling different cycles that we keep getting.
GM doing better this morning, that's for sure, off the back of those numbers. Equity futures right now on the S&P positive by 0.2%. The stage set as follows going into those numbers later on this afternoon. Yields are higher by 3 or 4 basis points. The 10-year 464.36. Coming up this hour, Morgan Stanley's Mike Wilson on why he's overweight energy. Matt Lazzetti of Deutsche Bank on his call for a single rate cut in December. And Mizuho's Vijay Rakesh on weakness in the EV market ahead of Tesla earnings a little bit later. We begin with our top story. Stocks higher after the S&P 500 snaps a 6-day losing streak. Morgan Stanley's Mike Wilson saying this: we believe equity markets have been trading poorly in April, primarily due to the repricing of Fed cuts. With 10-year yields now well above our key 435, 440 target, stock appreciation from here would largely have to be earned through earnings upside rather than multiple expansion. Mike, I'm pleased to say, is with us around the table. Mike, good morning to you.
Good morning.
How high is the bar or low for those tech firms through this week?
Well, it's mixed, as you were saying. It's not all one trade anymore. It's sort of the magnificent 3 or 4. Some are falling by the wayside for fundamental reasons. Some are falling by the wayside for rate reasons. And look, they've got tougher comparisons now. So I think that, look, it's always the case, right? It's not so much about the earnings results. It's about the reaction of the stock to the earnings results. And I think that's what I'm really fascinated to see, how much goodness is already priced into even the winners. And there are some big winners in that group. I agree with you, Lisa. I think what's more interesting is what's going on away from those stocks. That will inform us more about what's actually happening in the economy, what the expectations are around Fed, for example, and also some of the geopolitical risk, which I think, that's not our number one concern, but it's also one of the reasons we're overweight energy.
You said we can learn something from the earnings themselves and how the stock responds to them. What have we learned so far as we get deeper into earnings season?
Well, it's about 50-50. So 50% have been up, T+1, 50% have been down. That's worse than normal. This is in line with what we've been saying for quite a while now, as we think now we're in a period of multiple contraction, right? If you think about the last 6 months, all that really happened was, the Fed pivoted, Treasury, I would argue, sort of squeezed the bond market. We had a duration rally into year end, and that affected a huge multiple expansion. It doesn't get a lot of press, but 2024 estimates for the S&P 500 haven't really gone up, okay? They've been sort of flat over that 6-month period. It's all multiple expansion. So our call basically is that we thought 7 cuts was silly. I think a lot of people agreed with that. And now we're down to 1.5. So why wouldn't multiples come down in that environment? And I think that's what we're facing now during earnings season, is you've got to really put up a serious beat and a revision to the upside for the stock to go up. I'm very curious to see how that plays through the next 2 weeks.
What we're seeing right now in the earnings is not a cohesive story. I mean, honestly, you're seeing some areas where it's cost cutting that's keeping margins afloat, and other areas where you see, for example, demand for trucks in the U.S. going gangbusters. Are you seeing any themes that you can kind of grab onto so far?
The theme is that it's a very unbalanced economy, and that's the theme we've had for a while. So post-COVID, it's just been a very unpredictable environment for a lot of reasons. Some of those things we got really right, some of those things we got really wrong. And I think we're trying to figure out kind of what the next stage is. Let's look at the last year as an example. So a year ago, hard landing, recession was the consensus view. Market overpriced that. Then we got a soft landing priced in 2Q. Then we had a sort of a fiscal sustainability problem where growth got too hot and rates went up and we had a big correction. Then we went back to the soft landing, and now we're in no landing. So this is our view at the beginning of the year. It's like there's a 33% chance of all 3 of those happening. Soft landing, no landing, hard landing. And I think it's the same. So in other words, right now we're trying to price that no landing scenario, but I'm not confident that we're going to stay in that environment. And companies are a reflection of that, right? Some companies do better in that scenario. That's why they're doing better, things like energy, materials, financials. But is that sustainable? We're going to find out.
You said that we're going to see how much multiple expansion could continue and whether we see multiple contraction. The multiple expansion has been really concentrated in big tech. It has been really concentrated in some of the quality names that you like. It has not been concentrated in the Russell 2000, which has not experienced that same kind of run. Do you start to like some of those areas because suddenly it is an economy that's okay, maybe supported by a couple rate cuts, and frankly, you haven't seen that multiple expansion?
Well, we did. I mean, November and December was one of the biggest short squeezes I've ever seen in the lower quality parts of the market. So we did absolutely see multiple expansion. Now we're giving some of that back, right? And that's our call, which is that I don't really want to go to the low quality world, okay? And that includes small caps. Not all small cap companies are low quality, just to be clear. But as a group, okay, Russell 2000 is a low quality index. And that's why it's underperforming again, because rates are too high for them, right? Like R-star, people talk about R-star, okay? Well, R-star is different depending on who you are and what kind of company you run. It's extremely variable, and the market's been really efficient, Lisa, in saying, look, rates are too high for a majority of the economy, whether it's consumers or small businesses. So we're sticking with that. Until rates really get cut, we think that the trade is still, you got to go with self-funding businesses that have idiosyncratic kind of growth opportunities or pricing power. And it's playing out again this year in spades.
A lot of people think about you as a bear because yesterday, for last year, I should say, you were really calling for some sort of downturn in the economy. Where are we in terms of that cycle, in terms of just how close we are to a downturn? Are you basically saying, you know what, this isn't something you can really call with any definitive conviction, that you have to sort of just look at specific companies and stay away from that stuff?
Yeah, no, it's a humbling business. And I think 70% of the street, I think, was in the recession camp a year ago. Our economists were not, but a lot of people were in that camp, and we had to reprice that out. So where are we? We think we're still very much late cycle. I heard you all chatting. One of the questions we've had is, well, why can't it be early cycle? Okay. Well, there's a lot of reasons why we don't think it's early cycle. Labor market's very tight. The yield curve is still inverted. We don't have a lot of supply in the labor market. We have immigration maybe supporting that, but generally it's a tight labor market. Margins are still at record high levels. So all of the things that we would look at from an early cycle perspective are just not there. So we're still late cycle. And what does that mean? It means this can last for another 2 years, or it could be over tomorrow if we have another shock. So we're probably going to sit around. We're not going to be as aggressive trying to make that shock because we don't know what it is. We thought it was a regional banking crisis last year. Turned out to be not the case. The economy turned out to be stronger. I would also argue that we have an incredibly imbalanced policy mix, which has helped the economy to sustain itself. So economic data does not look like the earnings data to us. Okay, economic data is much stronger than the earnings data. Why is that? An enormous amount of fiscal support into the economy is keeping the economic data looking strong, which is preventing the Fed from really cutting rates for an early cycle rotation. And we're just kind of stuck in that. And we could be there for a while. Like, I don't see that breaking. I don't see any discipline in Congress. We're spending more money this week with this bill. I mean, so that is where we are. The question is that overpriced? And I think it is, because should I pay a higher multiple for what I call low quality growth, government sort of driven growth? I would argue no. For some companies, you can pay a higher multiple because they're idiosyncratic to that. And that's what's happening. Companies that don't need government support are doing better. Companies that are getting constrained by higher rates are underperforming.
Let's talk about fiscal and the fact that it doesn't matter who wins the election. There's going to be more money coming out of Washington. It's one of your questions you ask in your note. How are you thinking about the election as a driver of markets this year? Is it too soon to start preparing for November?
Yeah, I mean, historically, we put this in a note. I mean, typically the volatility of the market picks up 2 to 3 months before the election. My experience is that until we have the conventions and we really see the platforms at the stock level, we don't see a lot of action. Now, interestingly, this year, the market has rallied in the beginning of the year. Typically, it doesn't do well in the first half, and it does better in the second half as it becomes more clear. So is that going to reverse this year? We have a tougher second half, maybe. But I agree with your first sort of position, which is I don't see a lot of difference between these two campaigns in terms of the fiscal and even the monetary mix. The one thing I would say is focus on the areas where the president can do things that are executive order, okay? And the biggest one in my mind is immigration. Oh. And tariffs, that's the second one. So tariffs and immigration can be done without congressional voting. So that's where I think, because I'm not confident that we're going to get a sweep either way. That's probably the least likely outcome. It's probably a 10% chance. It's going to be very close. But to get one party as a sweep, I think is going to be challenging. So the executive order lever, if you're thinking about Trump or Biden, that's where the action is going to be.
I just want to work that through an extra step. Are you suggesting that maybe if we get a President Trump Volume 2, that this supply side nirvana that some people in the world of economics are embracing might be threatened?
I think that's exactly right. I would argue that there's a chance that maybe something is done prior to the election for political reasons, because this is a hot issue for the election, right? Immigration, it's a hot topic. And the question is, do they try to curtail some of that inflow prior to the election? I have no idea. But we're going to learn more about that, I think, in the conventions in terms of how they're talking about it.
To your point then, Mike, this could change quickly in the space of a couple of months. I'm just trying to work out how quickly that would show up in the data, how quickly the market might respond to that change.
Well, here's the real takeaway, John. I feel like there's been a lot of marking to market going on, right?
Okay.
So I would argue everybody's been wrong about the fundamental picture in many, many ways over the last 2 years, including ourselves, okay? And that marking to market, all of a sudden you mark yourself to market. Why are you any more confident you know what's going to happen next, right? And that's where we have a problem with valuations, is there seems to be this perceived certainty again being priced in. It's like, I'm not certain at all. Maybe I'm the dummy in the room. I don't know. But like, I feel like there's a little bit of complacency around just knowing what's going to happen. By the way, that's not all bad. There could be some positive surprises. But those positive surprises may lead you to a different group of assets that you want to own, okay? I mean, I think bonds are, just to spend a minute on bonds.
Sure.
I mean, my goodness. I mean, this is one where I literally could flip a coin and I would, okay, that's it. Because I could see rates higher from the standpoint of fiscal sustainability problems. We have a term premium increase like last year. Or I could see things slow down again because rates are now higher, right? The wealth effect is kind of being priced out of the market and maybe things slow again. Our house call is we're going back to sort of 415. I think you just had a guess saying 375.
Yeah.
I mean, 375 would argue that we're probably back into a soft landing or hard landing scenario. 415 is kind of more of the things just kind of slow down a bit.
Can I put you on the spot just a little bit? Is it easier to foresee than being 100 basis points lower than being 100 basis points higher? Or you actually think it's a coin split? Yeah.
100's big.
Okay.
And those are the tails, right? So 100 on the upside would be the market is really concerned about funding sustainability, almost like the UK, okay, 2 years ago. And I think 100 basis points lower from here is kind of a hard landing.
Give me the next 50.
Yeah, so 50, I'm still leaning to higher.
Okay.
But our house call is lower, so and I got to go with the house call. Because,
Not trying to cause trouble here, Mike.
No, they're
bond,
but the bond guys. That's their job, and so I got to bet with them.
Okay.
And so that would be okay. So what happens in that scenario for stocks? Well, all of a sudden our no landing scenario probably isn't the case, and we probably would downgrade energy, and we probably would go back to some of the things that were doing better last year. And so it's just, I think you just got to keep a really flexible, open mind. That's what we try to do now with the stock picking. We haven't really talked much about index in the last 4 or 5 months because we're trying to focus on the relative value trades, and we've gotten a lot of those right. And hopefully, knock on wood, we can continue to do that.
Stick with us, Mike. You're going to stay close. Mike Wilson there of Morgan Stanley. Equity futures fade just a touch as Mike speaks. Positive by 0.1% on the S&P. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Biden has weighed in on anti-Israel protests on college campuses. The president told reporters yesterday, I've set up a program to deal with it. I also condemn those who don't understand what's going on with the Palestinians. Columbia and Yale are cracking down on the protests. 100 students at Columbia were arrested and 60 at Yale. GM shares higher pre-market, up about 4.33%. It lifted profit guidance for the year with robust truck sales. The company's sales and earnings in the first quarter both came in above estimates. That lift in guidance, it overshadowed a slump in China, where GM lost about $100 million last quarter, and it's a region that which won account for $2 billion a year in profit. Amazon has introduced a new grocery delivery subscription. It'll cost you $9.99 if you're a Prime member. The subscription offers unlimited grocery deliveries on orders over $35 from Amazon Fresh, Whole Foods, and some local grocery and specialty retailers on Amazon.com. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, U.S. aviation facing headwinds.
If you think about 100 aircraft removed out of Boeing's forecast to start the year, that could translate into a big price momentum for the U.S. airlines, which have been suffering.
More on the U.S. airlines up next. Live from New York this morning. Good morning. Equities fading just a touch. We're positive by 0.1% on the S&P, going into the open in about 1 hour and about 12 minutes away. Yields are higher by 4 basis points, reapproaching 465 on a US 10-year. Under surveillance this morning, US aviation facing headwinds.
Boeing is sort of in this purgatory right now. They're at this very low production, and that brings us to airlines in a way capacity is very tight in the U.S. If you think about 100 aircraft removed out of Boeing's forecast to start the year, that could translate into a big price momentum for the U.S. airlines, which have been suffering.
Here's the latest. Boeing set to report earnings and issue guidance tomorrow amid a slew of issues and investigations. Meanwhile, JetBlue, those shares are falling in the pre-market. The airline disappointing on second quarter and full year guidance. That name is down by almost 11% in the pre-market. George Ferguson of Bloomberg Intelligence joined us now for more. George, let's talk about the airlines because it's not one big broad story. Talk to me about the names that are doing okay, doing well even, and the names that are struggling.
Sure, yes. So good morning. So far we've seen United and Delta report, and they were pretty decent reports, as well as Alaska. And they were decent reports, and it was all built on the strength of revenue. And those are airlines that have a good component of premium in their revenue mix, right? Front of the cabin, higher price point seats. This morning we saw JetBlue report. JetBlue has Mint. But they have more of a mix of Caribbean, which we know there's a bunch of weakness. There's a lot of capacity going into Caribbean and Latin America, and so it looks to us like this is more of a story of that basic part of the cabin is a much more difficult place for airlines to get any decent price out of, and so that's kind of hurt profits during 1Q, and the 2Q guide was. For revenue falling more than capacity is falling, which is telling me that yields fares are falling faster. So it's sort of a bad sign. So I kind of chalk this up to, again, that basic economy section of the JetBlue airplane, as well as some of the mixed Caribbean, creating some problems for JetBlue.
George, we've been talking about this for a while, the idea that an airplane perfectly represents the bifurcated economy, with the people up front doing just fine and the people in the back really struggling, particularly with pricing. This came in worse than expected. What does it say for other airline earnings expected to come out?
So we're about to go in to earnings for the lower cost airlines. We'll have Frontier, we have Spirit. Spirit's already given us a bit of a guide. And we've got Southwest. So I think what it indicates to us is, again, we're going to see it's going to be a rougher story for those airlines and earnings because they just don't have the premium content to bolster revenues. And so, what we're hearing from every corner of this market is if you can find a way to create more premium content, you will. Frontier's even creating premium content by taking out the middle seat in some of their airplanes. So, meaning taking out blocking the middle seats, have someone sitting next to you. So I think, again, where we're going to end up is airlines will step on that premium seating, demand as hard as they can. And we're seeing that everywhere in the market until that probably breaks down a bit too. But if you don't have a lot of premium seating, you're going to have a real hard time maintaining revenue, and that's going to hurt earnings.
You lost us at Frontier and Premium, George. You've got to go. George Ferguson at Bloomberg Intelligence. George, thank you. Not to be a snob at all. Morgan Stanley's Mike Wilson with us around the table with thoughts on this. Mike, let's not talk about this. Let's talk about your overweight on energy and what it means for your view on the US consumer and discretionary at the moment. How does one inform the other?
Well, look, it's self-correcting. This is probably more of a trade than sort of a secular call. I mean, look, energy got killed last year. It was a major underperformer. And what we noticed was that the revision factors were actually starting to turn up. Crude leads revision factors by about 4 months. So this, from our standpoint, this is a call about earnings revisions, not about geopolitical risk. But the geopolitical risk is still there, and it's a nice hedge in case something bad happens in that world. So from our standpoint, it's probably 50% done with this trade on a relative basis, but we think it can carry into the summer. It's a revision call. The oil prices don't need to go up for this to work because crude leads by 4 months, and it's pretty much that simple.
But to John's point, when does this become a tax on the consumer at a time where you do see weakness elsewhere?
Well, I think at oil at these prices is fine. I mean, gasoline at $4 is typically the threshold where the consumer starts to really push back. We're kind of up around that level now. But look, crude has come down in the last week. I mean, we're 83, I think, on WTI. That's down about $6 from the peak. And so that's informing me that we're okay for now. If we were to shoot to 95 or 100, oh yeah. And by the way, as part of this trade that we put on, we are underweight consumer discretionary. Okay, so we think the consumer is weaker for other reasons beyond, gasoline prices. We think a good chunk of the consumer is, hurting. I mean, this gets back to the comments on the airlines. It really is a have and have not world. Okay, it's playing out everywhere we see. And the consumer right now is being very judicious with their pocketbook. They're borrowing a lot in credit cards, but that's getting expensive, and we're seeing some delinquency action there. Nothing recessionary, but like at the margin, it's just harder to get that dollar to your company. So consumer discretionary is going to be difficult.
In the energy space, what else do you like outside of crude?
Well, within energy? Well, I mean, anything that's levered to crude. So basically and this is an important point I want to make. When we upgraded energy, we said, look, you still got to stay up the quality curve, right? This is not a situation where we think, you want to be going down the quality curve to the bad balance sheet. So integrateds, some of the higher quality E&Ps, and we mentioned those in the note when we upgraded the group.
And what about gold? I feel like we have to talk about metals.
Yeah, we're still pretty positive on gold because, this gets back to the issue of the fiscal sustainability. And we haven't talked about this yet, but fiscal dominance is a topic we brought up almost 4 years ago. And we think we're in a fiscally dominant policy world. It gets back to, fiscal's too heavy, which is keeping the Fed tight, and then liquidity has to come in and fund that. So at the end of the day, gold is telling you that the markets are starting to worry a little about fiscal sustainability, maybe more than what you're hearing in the press. It also started, if you think about gold, how it's traded relative to real rates, that's probably your number one signal. Real rates have gone up significantly in the last 2 years, and it's kind of a vote against sovereign. I mean, that's what's going on. Central banks are buying gold, and we think it's a really good hedge against fiscal sustainability becoming a problem.
There's one piece missing. It's the dollar weakness that you'd anticipate off the back of those questions around fiscal sustainability. Why is that piece missing?
Because everybody's got the same problem. I mean, tell me a major country that doesn't have the same issue. So all of the currencies are depreciating against gold or crypto. It's the same trade. And by the way, it's sustainable. It's not like the end of the world necessarily tomorrow.
You like Bitcoin?
Well, the market does.
Do you?
I like gold better because I think it has a longer standing sort of view, or has a longer standing sort of history of being a good place to be in this outcome.
This was really thoughtful stuff, Mike. Got to do it again. It's been way too long. Mike Wilson there of Morgan Stanley, particularly the last call, Bramo, on gold. We're always looking for the Bramo cam. I can tell you I've got a live feed. It's constant. Bramo's face lighting up the moment Mike Wilson talked about Bitcoin.
Well, he even mentioned, well, okay, Bitcoin, yes, because I'm just curious whether he's a Bitcoin bull, but also this idea, he brought up the Liz Truss moment that a lot of people mock, right? I mean, obliquely, but there is this question about when this becomes a real issue. Everyone says, not a big deal because of the dollar strength, which is exactly your question, John, and rightly so. At the same time, that telling gold, fascinating, one to watch.
Gold this morning, just a little bit softer. Up next on the programme, Deutsche Bank's Matt Lazzetti looking ahead to GDP and the Fed's preferred read on inflation a little bit later this week. Equities positive by 0.2%. This morning, looking at the bond market, yields drifting higher by almost 4 basis points. Now let's round it up for you on a 10-year, 4.65 from New York. This is Bloomberg. Equities positive here by 0.2% on the S&P 500. Just a little bit of a lift, no drama here. Up by 0.2% on the Nasdaq 100 as well. The Russell pulling back. It's been a struggle over the last month, as you all know. We've been down much more than this, that's for sure. Down by a third of 1% on the Russell. The small caps just a little bit weaker. Turn to the bond market. Here's the story for you. Going into the PMIs about 1 hour and 15 minutes from now. Yields are higher by 4 basis points. 464.36 on a 2-year higher by 2 basis points. Threatening to break through once again 5%, like we did briefly in the last week a few times. 499.13. Lisa, as you said, supply is very much the focus over the next few days, and the front end of the curve is going to be where that supply lands.
$69 billion of auctions of 2-year notes being sold today at 1 p.m. What that take-up is going to look like could dictate where the market goes. Yesterday, some people saying because the 2-year yield remained behaved, that was the reason why it allowed some breathing space for a rally. How much is it sort of the tail that's wagging the dog of equities?
499 on a 2-year. Lisa went through the supply. 2-year today, tomorrow 5-year, $70 billion worth. I mean, this is serious supply, sort of record issuance. 7-year notes, $44 billion worth. So a lot of supply still to come through this week. Let's take it from the bond market to foreign exchange. I want to talk about one currency pair and some levels. And the levels we were told that were important have turned out to be maybe not so important. 152 was the level for dollar yen, and then it was like 153, and then very quickly 154, and this is going to be a problem. Now we're pretty much at 155, 154.82. So the authority around the currency lies in the finance ministry, and we heard from the former guy, like the old guy, and this is what he had to say. The former vice minister of finance for international affairs in Japan. He said, we are very close to intervention. I want to understand what that intervention actually looks like and whether it's actually going to be, if it's going to be powerful in any way, shape or form, powerful enough to do something about this.
Right now, I'm just going to gauge the market's response. The answer is no, absolutely not. Because for the former FX chief to come out and say, it's very close, it's almost there, come on, we're going to go a little bit further, they've lost credibility at this point in terms of signaling some sort of verbal intervention.
Verbal intervention has been hanging over the FX market now for months, and we just keep going through those levels, driven by dollar strength and higher rates stateside. Under surveillance this morning, the FTC suing to stop Tapestry's $8.5 billion takeover of Capri. It's the Biden administration's first antitrust action in the fashion industry. Regulators saying the deal would harm consumers and workers. The Tapestry CEO saying shoppers have a wide range of price points to choose from. Everything I've seen so far has made this sound as ridiculous as it sounds. I'm looking for someone to actually come out with a decent defense of this. Explain to me why this is happening. Are we sort of like avoiding the definition of luxury? Aren't prices meant to be high? Isn't that the whole point?
Yeah, I mean, I think the FTC is going to come out. Well, they did come out, and they talk about workers and the issue of what potentially this could mean in that competition space. What I find challenging is that the fact that regulators in Europe and Japan greenlit this deal. So why is it an issue in the United States? But then you go back to this statistic. Since their appointment, Lena Khan and Jonathan Kanter have brought the highest number of merger challenges since the U.S. began requiring antitrust reviews before deals close in 1976. They just don't want to do deals.
Okay, you asked for it.
Sure,
a defense of the deal. 33,000 employees. That's how many people would work for the combined company. And the fear is that you could reduce wages and reduce benefits really significantly if you combine the two companies and create economies of scale. Question really is, how do you compete with LVMH? How do you compete with the likes of Gucci, et cetera, if you are a major luxury brand? I mean, that's sort of the counter argument from the business community. From the Biden administration, it seems like this is more of a worker thing than worrying about your Jimmy Choos.
OK, if that's the case, if it's not about prices and the consumer, if that's the obstacle to closing a deal in America, we will never close a deal again. They come on TV every time they close a deal and talk about efficiencies and cost savings. What's that really mean? They're talking about job cuts.
I mean, basically, this is a reason why Brian Moynihan was saying a lot of things are getting iced. And I think that you're going to hear that more. OK, we'll focus on that story. It's an odd one, that's for sure. Apple facing another setback in China. Counterpoint research data showing iPhone sales falling 19% in the March quarter. Apple losing market share to competitors like Huawei, which saw sales climb 70% in the same period. Lisa, straight out the gate, you said it. The market's growing. It's not a market problem. It's an Apple problem. What I want to hear next week, what are they going to do about it? Are they basically going to just sit there and take it and say we have to because this is the main source of our production? Or are they going to actually start to say out loud, we're trying to shift to India? We're going to cut our prices further. We're going to talk with the government. We're going to try to divert, different streams of revenue. But this is a huge cloud that's been hanging over the stock so far this year.
It comes as yesterday, Bank of America named Apple a top 2024 pick ahead of these earnings. And they're talking about the prospect for, quote, services revenue growth and margins to remain strong. How challenging is that China story to that kind of outlook?
They might be right. We've reset the bar lower, that's for sure. We've had a double-digit move so far year to date. Stocks moved lower by more than 10%. Earnings about a week away. Data still ahead as well. US GDP coming Thursday. The Fed's preferred inflation gauge, PCE, on Friday. Bloomberg survey expecting core PCE to cool slightly year over year to 2.7%. Deutsche Bank's Matt Lazzetti seeing fewer and later cuts. He writes this: we now expect only one rate cut this year at the December meeting, followed by modest reductions in 2025. Matt is with us now for more. Matt, congratulations, because I think a lot of people have moved to your view of the world. You were talking about a mid-cycle adjustment quite a while ago, and I think everyone else has caught up now. This is no longer about the start of a cutting cycle and perhaps an adjustment mid-cycle. Can you frame the difference and what led you towards that conclusion?
Yeah, absolutely. So we have, I think, two historical examples of mid-cycle adjustments. You had one in the mid-1990s, you had one in 2019. And the logic there is the Fed is cutting rates not necessarily because we're in a recession, but maybe they're seeing some weakness in the economy that they're trying to get ahead of, or they're seeing that inflation is coming down substantially. I think this cycle was going to be all about inflation coming down and the Fed being able to cut rates modestly in response to that. Certainly we're seeing that get pushed back. But with the labor market where it is, with growth as resilient as it is, with financial conditions as easy and accommodative as they are, there's really no reason for the Fed to guide towards a full cutting cycle at this point in time.
Pre-pandemic, I remember a phrase that Chairman Powell talked about. The objective was to extend the cycle. Is that the objective now? And where are we in the so-called cycle?
Yeah, I think you've seen Fed officials talking about risk management for a long time over the past 3 years. Risk management has meant being hawkish, raising rates in order to ensure that inflation doesn't become entrenched. I think 3 or 4 months ago, we saw better balancing of those risks as inflation was looking softer and the Fed became a little bit more worried about growth. I think the past 3 months of stronger inflation prints have put inflation back to the forefront for the Fed. And extending the cycle at this point, I think, does mean ensuring that inflation does not get entrenched, not cutting rates prematurely. We hear more Fed officials talking about the risk that's the bigger risk, cutting rates prematurely, having to re-hike later.
I like Ben Bernanke's idea of scenario analysis. I would like to have a sense of exactly how the Fed would respond if certain things happen, since it's been such an unpredictable cycle. How many hot inflation prints will it take before we start talking about no hikes this year, or no more cuts this year? And how many weak prints does it take for the Fed to cut?
Yeah, I think we're close to talking about no cuts. Our expectation is the Fed only cuts once, and they cut in December. But we also expect that you're going to see disinflation come back over the next several months. So even if you get disinflation, 3-4 months ahead, I think the Fed is going to be a little bit more reluctant to cut rates because they've seen a head fake from the inflation data. It's going to take a while to rebuild that confidence. I think if you take a step back, core PCE inflation on Friday might be 2.7 or 2.8. We have growth, which around 2.25%. We have financial conditions that are easy. We have the labor market, adding more than 200,000 jobs per month on average with a historically low unemployment rate. There's just not very compelling reasons to cut rates within that environment, and I think the Fed is coming around to that view.
How much are they basically also kind of tacitly admitting that the pivot last year really kind of worked against their goal of disinflation, that might have actually contributed to the stickiness that we're seeing right now in some of the data?
I think perhaps it's somewhat of a contributing factor. I think a lot of this is maybe seasonal, so you do have some seasonal factors that boost inflation early in the year. But what that means is the disinflation we saw last year was overstated. And so overall, inflation is just going to be more elevated than we thought. I think financial conditions will help to boost growth as we look ahead, but I don't think that it's been a key factor for the stronger inflation prints of the first 3 months of the year.
Mid-cycle adjustment doesn't sound like we're near any kind of hard landing. And yet the different rolling cycles that we're seeing in a lot of these earnings reports and what people are talking about, the two-sided economy, it's very real. How do you play that out, given the fact that if rates remain at this level, the lower tier, the lower half, frankly, of the population is going to struggle all the much more so? And I'm talking about both companies and individuals.
Yeah, I think from my perspective, that's returning to more normal conditions. It is the reality of the U.S. economy that you have delinquency rates that are more elevated for lower income households, for lower education households. And so a lot of this is returning to a more normal pre-COVID environment as that excess savings gets drawn down. What we've seen in that environment still is robust consumer spending. We saw it with the retail sales report recently. We see GDP growth that looks quite solid. We see employment gains, which are above 200,000. We see households adding meaningful income growth with decelerating inflation. All of that, I think, is pretty supportive for still solid growth for the U.S. economy and something that the Fed shouldn't be worried about.
What about for 2025? How are you thinking about 2025, given the fact that we might have very different policies, fiscal, maybe immigration, coming out of Washington?
No doubt. And I think it's a key challenge to think that the Fed could cut rates in December. So when we change the view and we have one rate cut in December, I think that could be highly conditional on the election outcome that we get. If you get an election outcome that has meaningful fiscal stimulus and has inflationary policies, whether it's through trade or immigration, the likelihood that the Fed cuts rates in December is reduced. So I do think, as we look about potential to cut rates, the Fed certainly will have to factor in economic policies that will impact inflation, the labor market, and growth. And if those things suggest that they shouldn't cut, then they're less likely to cut.
Let's wrap it up with a counterpoint. Andrew Honhorst of Citi on the programme a little bit earlier this morning. He still thinks mid-year. Only until recently, you were looking for mid-year as well. Yeah. You pushed that back out to December. Can you walk me through how low the bar might be to a rate cut mid-year? I'm just trying to work out how this market would respond. Let's say in a few weeks' time, get a really soft inflation print. Do the conversations of the last month just disappear and we start going back to what we were talking about 2 months ago? How does all that work?
Yeah, I think to get a cut by June seems very unlikely at this point in time, absent a weakening in the growth environment. To get a cut by July, I think you need to see a pretty quick deceleration in the inflation data, because we've now had 3 inflation prints that were well above the Fed's objective. We see 3- and 6-month annualized rates, which have been accelerating. It's unlikely you get core PCE inflation down to 2.5% year over year by that period in time. So I think you really need to see a swift and compelling and convincing several prints of weaker inflation data, probably coupled with some weakening of the labor market.
What do you see in the inflation mix right now that makes you think that's very unlikely?
So when you look at things like trim, mean, and median, those things have remained elevated, telling you it's not all about outliers at this point in time. I would also highlight, last week we got this new tenant and all-tenant rent index data from the Cleveland Fed. It has a little bit of a lead. And the all-tenant index actually stabilized at elevated levels. And so that tells us at least through Q2, we're unlikely to see shelter inflation decelerate quickly. If that happens, we're unlikely to get the soft inflation the Fed needs.
Matt, this was smart. Always great to catch up. The brilliant Matt Lazzatti there of Deutsche Bank, looking for the first rate cut to come in December and looking for there to be maybe some moderate adjustment in 2025 and what the team over at Deutsche Bank are calling a mid-cycle adjustment. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares of Spotify higher pre-market, almost 10% so. Paid subscribers rose 14% year over year. They're now at almost 240 million. Spotify does plan to raise prices again for the second time in just a year. Shares of UPS also lower this morning. They were higher, down 0.4%, despite the fact that they did beat estimates in the first quarter and reaffirmed its guidance for the remainder of the year. The headcount management and restructuring of delivery routes appears to show through on its bottom line. Apple is close to inking a deal with FIFA to get worldwide television rights for a month-long U.S. World Cup-style competition. That, according to the New York Times. Again, it would be held in the U.S. next summer. It would be Apple's latest venture into soccer after its 2022 deal when it secured a 10-year contract for worldwide streaming rights to Major League Soccer. And that's your brief, John.
Danny, thank you. Up next on the program, all eyes on Tesla.
Tesla needs to be focused on cost instead of focusing on technology for the sake of technology. What I'd like to see is Tesla succeeding to make EVs into the foreseeable future.
Up next on the program, Vijay Rakesh of Mizuho on the blockbuster earnings report expecting for later on this afternoon from Tesla. The opening bell about 45 minutes away. Equity futures on the S&P 500 positive here by 0.3%. Yields are higher by 3 basis points. 463, call it 464. Under surveillance this morning, all eyes on Tesla. Here's the latest. Tesla set to report earnings after the closing bell. Shares down nearly 43% year to date. The EV maker at an inflection point as demand falls and investors worry about a shift in priorities. CEO Elon Musk widely expected to ditch the rollout of a cheaper model in favor of developing a robo-taxi. Vijay Rakesh, Mizuho Securities Semiconductors and Automotive Tech Senior Analyst, joins us now. He has a neutral rating on Tesla and a 195 price target. Vijay, we've got some time with you, I'm pleased to say, to work through a lot of issues. And the go-to question for us on this program over the last few weeks has been, do we have an industry problem here or a Tesla problem? Vijay, which one is it?
I think it's a little bit of both. I think in terms of industry, we have seen a very strong adoption of EVs the last 2-3 years. And now you've gone to the first round of early adopters on EVs. So now getting to the second round is a little bit tougher as most of the low-hanging fruit has been taken. So you are seeing broadly EV industry face some challenges, especially even in China, significant price competition. But that said, on Tesla specifically, you have a fleet that needs a refresh. Investors were looking for the Model 2. So that will be the focus of the earnings call if the Model 2 is still on track for second half 25, or do we see that get pushed out to 26, in which case, 2024 and 2025, you don't have a lot of new models coming to market. So I would say a little bit of both.
Vijay, if we don't have growth, how do you value the growth company? It's a question that Wells Fargo have tried to answer. You've raised this question too. What kind of valuations you put on that name?
Yeah, I mean, I think it's really a tale of two scenarios. One is definitely near term, where you have challenging growth expectations because of a fleet that needs a refresh. But longer term, you still have the secular tailwind that electrification is still very much on track, and we will see the global EV market grow significantly as you look out to 2027, 28, because that's where everybody is placing their chips. I mean, all the global auto OEMs, all global economies, everybody is pushing on the EV roadmap. So that's where the trend is. Near term, you have some challenges because you're facing a conundrum of lowering pricing, lowering costs to drive sales, and we are not there yet. The EV market still needs to mature to bring costs down, bring ASPs down. And the Model 2 would have been a very welcome addition to that fleet. But looks like there are some question marks around that. So,
given that, what gets us to $195 a share from the current $142 a share on Tesla as you project?
Yeah, I think a lot of the pullback has been given some of the recent trends in slowing EV sales, but also some doubt around the Model 2 timeline, especially if it's still on second half 25 or 26. I think the more clarity, CEO Elon Musk and Tesla can give to the street, the better chance you have for the stock to consolidate or move higher. So I think that's definitely what investors will be focusing on. I think robotaxis are a good roadmap, but obviously there are some significant challenges around regulatory compliance, getting the standards there, getting NHTSA to approve it, putting some guidelines around what is acceptable, what is not acceptable in autopilot, etc. So it's still a roadmap that needs evolving. Might be we see something happening by 2027, 28 at the earliest. So near term, the big focus has to be getting Model 2 back on track. So.
Vijay, we were talking about this with our own Craig Trudell earlier this morning about which Elon Musk would show up to the earnings call. How much does it matter to you, his tone, whether he likes you guys or whether he just excoriates you for boring questions?
I think, we have to disassociate the execution from, basically the valuation should be linked to the execution of the company. And so I think as Tesla has done an excellent job in kind of evangelizing EVs and growing that whole market and being first to market, and they have a massive balance sheet. So all those are not issues. Now the focus should be on getting the product roadmap back on track, getting growth back on track. So I think that's where, that's really what will tie valuation of Tesla stock is really the execution on the product roadmap and how that, how that top line margins evolve going out. So.
As it deals with this cost war, this price war in China, was it a mistake to get rid of the cheaper version, $25,000 Tesla?
I think we are not there yet, right? I think there have been, press reports to that model gets delayed. There have been, Twitter posts about not getting delayed. So I'm sure that's where all the investor questions and focus on the call will be. It's much less focus on what the earnings for the current quarter looks like because estimates for the current quarter have come down very significantly. So I don't think there'll be much of any concern around what the numbers are for the quarter and where the margins are. All the questions will be, how does Tesla get through 2024, 25? Is the low-cost model still on track, etc.? So I think that's really where the focus will be. That's really where all the questions will be based. So.
And as they plan to roll out the robo-taxi in August, you went through a slew of issues that they have to deal with before August. I mean, this doesn't even have government approval yet. What do you need to hear from Musk today to make you think that, okay, August, we can actually see this product?
Yeah, I mean, I think seeing the product is really not a big challenge. I think we can have the product there. The real question would be, okay, what's the execution on it? What's the performance? What's the driver intervention levels? What are the standards we are going to, be guided by in kind of commercializing the robotaxi? How many miles do we have? What's the customer feedback? So there is multiple challenges. There is level 3 autonomy that we haven't even gotten to yet. So I think there are significant challenges to that. And that's why we think any significant rollout will need not just a revamp, an upgrade on the Tesla FSD, but also significant infrastructural upgrades as well. And so it's a route that everybody wants to see happen. We have seen this multiple times before where timelines get pushed out. And at this point, I think it's fair to assume that 2027, 28 is where we think there could be any chance of really seeing robotaxis on the road. That's not geofenced, having a little bit more flexibility on where you run it, etc. At this point, it's still in the very early experimental stage. So.
Vijay, let's wrap things up by talking about leadership. Elon Musk wasn't always a polarizing figure. He's been highly successful. It's incredibly unique, the amount of success he's had across various industries. If you think about payments in the early days, the time at PayPal, I go back to what he's doing right now, innovations in healthcare. It's unbelievable. At the same time, he's doing things with SpaceX and again with Tesla, and we can talk about Twitter another day. But I think, Vijay, more recently, the experience of Twitter has led to this increased polarization of the man himself. When you have conversations with clients about leadership, do they feel like he's isolating a certain portion of the consumer base?
Yeah, I think, when you look at geniuses, as you mentioned, the list of accomplishments are long. I think they always tend to be eccentric. And so that's exactly why we have to, compartmentalize the execution of the stock and how Tesla itself is doing from personalities. I know it's very tough to do that, but I think when we look at Tesla or you look at SpaceX, you have to look at how is that company executing? What's the roadmap? Is there something that drives, valuations? What drives accretion in this company, etc. So, but obviously, like we said, every genius got there because of their accomplishments, because and none of them seem to be normal people. They all are eccentric, and they all have their quirks. So I wouldn't go there.
It's a double-edged sword. It's very diplomatic, Vijay. Well navigated. Vijay Rakesh of Mizuho. Look out for Vijay on the call a little bit later, trying to ask questions about some of these issues. Those earnings coming out after the bell later on. That stock is on a 7-day losing streak, the longest streak so far this year. The name is down by more than 40%. If you go through the S&P 500 individual members, the second worst performing name on the S&P. Given all the troubles that Boeing has had, that stock is down more than Boeing in 2024, which tells you a lot about the position this company's in going into this report.
It was such a high flyer, and now it's been the biggest laggard at a time where it's unclear what can actually revive faith in it. Is it going to be the robotaxi we just heard from Vijay? No. Maybe it's something else in terms of how they're going to get things on track.
To me, the robotaxi is like the carrot hanging over the stock for the rest of this year, sort of going into August, just waiting.
But it feels like a Hail Mary, right? Everyone's kind of like, well, we need regulatory approval. Maybe we'll see a product, but how do you actually get that product to market, what Vijay was saying? So it just feels like keep buying into this idea. It might work.
More on that a little bit later. Coming up tomorrow, here's the lineup for you. Pierre Ferragu of New Street Research, Mike Schumacher of Wells Fargo, Kate Moore of BlackRock, PIMCO's Tiffany Wilding. Fantastic stacked lineup for you tomorrow morning. Live from New York City this morning. Good morning to you all. The opening bell, 34 minutes away. Equity futures positive. This was Bloomberg Surveillance.